Hope you had a good evening yesterday. Didn't get soaked with the rain. So welcome to the discussion that we're going to have around measurements. As I foreshadowed yesterday, we will switch the sessions around. So we'll deal with John's item on the conceptual framework updates first. And then we will use the remainder of the session today to discuss measurement issues and current operational value in particular. When we get into that session, I'll introduce formally our guests for today from the valuation profession. So we've got Jonathan Fothergill joining us on the Zoom, and we have Steve Choi here with us in New York. So thank you very much for joining us today, and well, we'll bring you in after we've dealt with the first item. So I don't think there's any administrative items. Leah, is there anything we should say? No? Okay, good. So without further ado, John, if I can hand over to you to introduce the additional analyses that the board asked for last time.
Yeah. Hello, everybody. Morning. This is agenda item 5, and there are 4 substantive papers in the sequence 5.2.1 to 5.2.4 in the agenda item. And this is basically building on discussion that we had in March and the further analysis that the board instructed staff and also the board sponsor, Ian, as chair, to go away and have some further thinking and restructuring. Okay. As normal, we have the standing items in 5.1.1 to 5.1.3, detailing the project roadmap instructions and decisions, and for 5.1.2 and 5.1.3, how staff have implemented those instructions and decisions. Perhaps, Ian, through you, I could ask if anybody's got comments on those, maybe give them to me offline in order to save time. And there are references to the updated chapter 7 under development, which is at 5.3.1. And I'm not intending to go through that in any detail at this meeting. So
just to say, if there are any drafting comments or whatever, if you can pass those to John out of session.
Thank you, Ian. Right, the first then of the 4 substantive papers, 5.2.1 in pages 7 to 11 of the consolidated agenda item. And the first of these is assumption price. Assumption price defined in the 2014 framework in paragraph 3 and shown in paragraph 3 of the paper, the amount which the entity would rationally be willing to accept in exchange for assuming an existing liability. The preponderance of responses to the specific matter for comment on assumption price were supportive of its deletion, but there were comments made both at a conceptual and a practical level suggesting that we should take stock before deleting a measurement basis in the existing conceptual framework. We've then carried out further analysis looking at 3 aspects, and this is common to the first 3 papers. First of all, we've looked at the ISB approach. Did the ISB consider or include these measurement bases? If so, if not, did they give reasons for their approach? We've done a bit more work on the relevance of each of these measurement bases to public sector financial reporting. And we've also, at a very high level, taken stock of what we've been told in the various consultations on measurement, both the framework and ED 77, and the work at standards level on measurement that Dave has led. The first of those then in paragraph 11, the ISB approach. Well, neither the ISB's 2010 conceptual framework nor the much more expanded 2018 conceptual framework defined or described assumption price. So it's fairly clear that the ISB does not feel that this measurement basis is necessary in a corporate context. Just to explain that the ISB's treatment of measurement in the 2010 conceptual framework was largely material which was brought forward, inherited from the International Accounting Standards Committee's 1989 framework statement. So it did not say a huge amount about measurement. The 2018 framework included a much more detailed and voluminous treatment of measurement. Turning then to the second of those 2 points, relevance of assumption price to public sector financial reporting. Well, at paragraph 13, in a for-profit context, it's rational for an entity to assume a liability if the entity can settle that liability for a lower amount after taking account of estimated transaction costs. In the public sector context, there may be public policy reasons why an entity might want to assume an existing liability. The examples I've given are assuming pension obligations to sustain the viability of a pension scheme, or assuming loan debt, which may be important to the future going concern considerations of a strategically important economic sector. And in those cases, it would be necessary for the reporting entity to be aware of assumption price. However, for financial reporting purposes, the use of assumption price seems highly limited or negligible, because assumption price will be transaction price. That will be the root of historical cost. And once an entity has assumed the liability, the measurement basis, which meets the qualitative characteristics and gives useful information to those reliant on the financial statements, is cost of fulfillment. And the paper includes at Appendix B a very brief, high-level discussion example of how assumption price might work. Okay, and that's meant to exemplify the assertions in paragraph 15. What have respondents told us previously? Well, not a great deal. There doesn't seem to be much support, if any, for assumption price. And of course, we've been told at a higher level of the need to ensure that there is consistency between the conceptual framework and the standards level advice we're developing from ED 77. So there doesn't seem to be much push from constituents for retention of assumption price. All this has led both board sponsor and staff, has really reinforced our view that assumption price is not necessary in a revised Chapter 7. Now, as with the other bases and as discussed previously, this does reflect a difference of view between, on the one hand, the view that the conceptual framework should be highly voluminous and should include a broad range of measurement bases, regardless of whether those measurement bases are likely to be used in practice, or a view that the conceptual framework is more user-friendly if it just focuses on those measurement bases that are likely to be used very commonly in standard setting. And we've certainly gone down the latter of those two routes. So the recommendation is that we continue with the non-retention of assumption price, which was proposed in Exposure Draft 76. And that's the decision we're looking for today. Thank you.
Thank you, John. I think this is a very useful piece of extra thinking that has taken the arguments forward, because essentially what you've done is to demonstrate that assumption price is not needed as a separate paper, as a separate basis. You know, it's redundant effectively. That then addresses the sort of comment that, well, we should effectively retain assumption price for old time's sake. And we've also got strong stakeholder support at several stages for deletion. So in terms of the debate this morning, I'm only looking for any substantive arguments that have been missed for retention. So with that, open for any comments. Okay, so I think we agree with staff's recommendation that assumption price is deleted. Okay, so move us on to the next page.
Yeah,
John.
thank you. Thanks, everybody. The next of the measurement bases, which we first looked at in March, we looked at the first set of responses in March, cost of release. This is agenda item 5.2.2. Again, the paper follows the same format. So there's background giving the definition or description of cost of release in the 2014 framework. That's paragraph 3. And that's the amount of an immediate exit from the obligation. Cost of release is the amount that either the creditor will accept in settlement of its claim, or a third party would charge to accept the transfer of the liability from the obligor. Again, the responses to the part of the specific matter for comment on cost of release were supportive of not retaining this measurement basis. We had similar arguments that were made with assumption price as to why it might be premature to delete this measurement basis, or there might, and some practical examples where people felt it might be relevant. They mentioned provisions and financial instruments. There was a broader view that the framework doesn't say as much as perhaps it should on liabilities, and therefore we ought to retain cost of release. But that response didn't actually identify any circumstances where it would be relevant and faithfully representative. Right, turning then to the further analysis, paragraphs 11 onwards, the ISB approach, the 2010 conceptual framework, which, as I've said, was inherited from the International Accounting Standards Committee's 1989 framework, didn't discuss cost of release. However, when the International Accounting Standards Board developed its extensive measurement guidance, which culminated in the 2018 conceptual framework, the ISB did consider cost of release, and the basis of conclusions, this is in paragraph 13 of your papers, the basis of conclusions describe cost of release as depicting the estimated cost, including transaction costs, of obtaining release from a liability by negotiation with the counterparty. Now, that actually is a slightly narrower concept than the one we have in our 2014 framework, because our 2014 framework, as indicated by the description in paragraph 3, also includes the amount that a third party would charge to accept the transfer of a liability as a branch of cost of release. Okay. But broadly, the two descriptions are consistent. And crucially, the ISB decided against including cost of release in its 2018 framework because it felt that it's relatively unusual for entities to obtain release from a present obligation rather than settling that present obligation through fulfillment. Okay. And board sponsor and staff both think that there are no stronger reasons in the public sector than in the private sector for retention. Now, when we look at the relevance to public sector financial reporting, we've already noted that in IPSAS 19, there is one paragraph which is broadly consistent with cost of release. In other words, it does acknowledge that settlement might be through release as well as through fulfillment. So it is slightly more complex and nuanced than with assumption price. However, when the board sponsor, Ian as chair, and I've considered this further, we've given our analysis in paragraph 15. We think that cost of release gives rise to accountability and audit and assurance issues related particularly to the qualitative characteristic of verifiability, because negotiations with a counterparty for release or a third party, they're likely to be sensitive, confidential, not in the public domain. So the circumstances where cost of release would be relevant, we feel, are very narrow. And from an accountability perspective, I think cost of release gives rise to public interest considerations because it opens up the idea that public sector entities can settle obligations at a discounted rate rather than fulfilling them. Again, as with assumption price, Appendix B provides a couple of simplified discussion examples related to cost of release. The first of these is where an entity has received services and because they're in budgetary difficulties has persuaded the provider of those services to accept a lower amount in settlement of the obligation. The second is where an entity's environmental obligations are transferred to a third party. And somebody commented to me that these are a little bit outlandish, and I think that that comment demonstrates the fact that cost of release is unlikely to be relevant in many circumstances. Therefore, as with assumption price, we are proposing that we persist with the approach in ED 76 and don't retain cost of release in a revised Chapter 7.
Okay, thanks, John. And I think, again, that's useful further thinking around the reasons for deletions. So, you know, there are accountability issues. You can use other measurement bases perfectly satisfactorily. So essentially, it's not a concept that we should retain, and we've got strong stakeholder support for its deletion. So again, are there any substantive reasons for us to retain? Okay, so we accept staff recommendation for deletion.
Thank you. Right, we'll then move on to the third of the measurement bases where we were instructed to do further work. That's net selling price. And again, looking at the slide, exactly the same structure to the paper. At paragraph 3, we have the definition of net selling price in our current 2014 framework, the amount that the entity can obtain from sale of the asset after deducting the costs of sale. Similarly to assumption price and cost of release, general support for the approach which has been outlined. However, some disagreements similar to those at a conceptual level that I've talked about for assumption price and cost of release, i.e. the framework should be broad and that it's too not enough time has elapsed since publication of the framework to justify deletion of measurement bases. If we look at practical reasons for retaining net selling price, well, a small number of respondents suggested that net selling price is relevant for the measurement of inventories. And we look at that argument further in the paper in paras 15 to 17. And I think that's where our most interesting discussions took place, because certainly I was initially quite persuaded by the views of those who argued that it's relevant for inventories. However, when I did a little bit more thinking, I realized that my initial thinking had been a little shallow, and I don't think that it's as useful for inventories as these respondents suggested. What's the ISB's approach? Well, the ISB in 2010 included something called realizable value. This is at paragraph 11. And what they said is assets are carried at the amount of cash or cash equivalents that could currently be obtained by selling the asset in an orderly disposal. Liabilities are carried at their settlement values, that's the undiscounted amounts of cash or cash equivalents expected to be paid to satisfy the liabilities in the normal course of business. Now, although the terminology seems vaguely similar, realizable value really is not the same as net selling price in the way we have defined it in our framework. Firstly, realizable value assumes an orderly disposal. Net selling price doesn't. The ISB's 2010 framework didn't actually go into any detail on what an orderly disposal is. So regardless of terminology, realizable value in the 2010 ISB framework is actually closer to fair value in IFRS 13 than it is to net selling price as we have defined it. The ISB's 2018 framework did not include net realizable value. And the basis for conclusion stated that net realizable value depicted the estimated consideration from the sale of an asset reduced by the estimated costs of sale. And the basis for conclusions to the 2018 ISB framework said, we think this is unnecessary to describe net realizable value separately because it's derived from another current measure. And that other current measure is fair value. When it comes to the relevance of net selling price to public sector financial reporting, the analysis is in paragraphs 14 onwards. There is a view that net selling price might be relevant where sales are on a negotiated rather than on a market basis. And if you recall, the board looked at this argument in the development of IPSAS 44. The work that they did on IPSAS 44, non-current assets and discontinued operations. And the board there said, right, well, if it's clear that the sale is going to be on negotiated terms, should we actually factor net selling price into the recoverability of the asset? I remember that discussion quite well because I was the only person in the room who felt that that was a viable argument, and I was banged down quite quickly. Ian gave me a glare, and the board came to the view that the appropriate measurement basis is fair value, and fair value less cost to sell is what you have in IPSAS 14. The other point to make, I think, here, and I excuse the typo in paragraph 18, is that IPSAS 12 is drawn from IAS2. IAS2, I think, is actually the ISB's oldest standard. It dates back to the 1980s. And whilst it's counterfactual, second guessing, I think the view of both Ian as board sponsor and me is that if we were starting to develop a standard on inventories from first principles, we probably wouldn't include net realizable value as a definition in that standard. It would be fair value. So again, on the basis of financial reporting, we don't, firstly, to say net selling price is not the same as net realizable value in IPSAS 12. And secondly, even accepting net realizable value is in our literature, we don't think that it's necessary to go into detail about this and in a concept statement. And lastly, what have constituents told us? Well, again, there didn't seem to be very much of a push for retaining net selling price in responses to the initial consultation paper on measurement or ED 77. So that was quite consistent with the feedback we got on ED 76, which, as I've said, in pure quantitative terms, and there are risks in just looking at quantitative responses, there was strong support for non-retention. So as with the other two, the view is that we don't need net selling price in the framework. In fact, we think that there are actually some risks of including it. And therefore, we're looking for confirmation from the board of the recommendation not to retain net selling price.
Thanks, John. And again, I think it was very useful to actually do that further thinking and to, really build on, for example, the fact that we approved IPSAS 44 at the last meeting and so on. So again, I think, although more nuanced, it demonstrates that there is no need to actually retain this as a basis in the framework. And given the again, support from stakeholders, just to ask the board whether there are any substantive arguments that they think would counter the analysis that John has done for us. Ajith.
Thanks, Ian. I was just wondering of a situation in the case of an inventory where something is in work in progress, and we would, in relation to inventory valuation, we would normally look at the subsequent costless net realizable value is what we've been looking at so far, and that is what I think believe in the inventory standard. I was wondering whether, in the case of an item in work in progress, the identification of the subsequent cost and then having a finished good and then being able to recover that finished good is a principle that we have been looking to see whether the cost is appropriate to measure the work in progress. So in that particular situation, I think we will not be able to call the work in progress item as the net realizable value of that work in progress as a fair value, because the fair value requires an item to be a market price where buyers and sellers are able to fix a price. But when the item is in work in progress, it's difficult to identify or describe it as fair value because it is very entity specific, because it's partly manufactured product, and then the subsequent cost need to be identified, and then we have to see whether the cost is, whether the net realizable value or net selling price is sufficient for the cost. So I was wondering whether that aspect was considered. So just a question I would like to ask John in relation to that. Thank you.
Thanks, Ajith. I mean, I don't think the question you've raised actually is really in support of net selling price. I think it's actually more a detailed question in terms of how you would value work in progress, which so I'd suggest that perhaps you have that discussion offline, but I can't see a reason therefore, in terms of the situation you've described, that would actually support net selling price. I think the same issues would, apply to that as with fair value, less, costs of sales. So I think that's not going to be a strong argument for retaining net selling price. Claudia, perhaps I can go over to you.
Thank you. Sure. It's not something specific to net selling price. It's more an observation to all three measurement bases. I'm wondering if you would add in the BCs the view of the board that we changed from the wider view of including all the different possible measurement bases to a enger view that we only include which might be possible usable in the public sector. I would be helpful if you could find somewhere of this idea John has presented.
Yeah, thanks for that, Claudia, and I agree with that. So I'll consider what is in the basis for conclusions at the moment, and also the introduction of the kind of generic paragraph that you're suggesting. Thank you.
Yeah, and I think that's consistent with the direction of travel that we've gone through the consultation paper to the ED, and at each stage we've, in developing ED 77, we said it's only the ones that we would need to use in practice that would go into that. So I think, yeah, that absolutely works. I think it was Chris first and then Lynn.
Thank you, Ian. Claudia just took the words out of my mouth. I was actually going to address the three items generally, and as public sector standard setters, we know that public sector accounting is actually about accountability rather than stewardship reporting as in the private sector. So any little item that supports accountability is very, very important. And so when we voted to drop this second item, cost of release, not cost of release. The first one was assumption price. The second one was cost of release. Yes, when we voted to drop it, even though we had highlighted that there is some support of accountability in it, I was wondering whether we were considering, and this just for my education anyway, my enlightenment, whether we were considering the fact that it was not adequate, I mean, it was not necessary to incorporate such detailed concept in the conceptual framework, but we could, at individual standard level, employ them. And that's what I wanted to be clarified.
Yeah, again, I'll look at the basis for conclusions, because one of the things that we've been trying to do is to say, look, we're not necessarily precluding the usage of other measurement bases at the standards level, but we don't think that the circumstances are sufficiently prevalent across the suite of the literature, of standards in the literature, to include these in the conceptual framework. But I'll note that point, Chris. Thank you.
I mean, I think that's a overarching thing with the framework, that it is non-authoritative, it's the standards level. But I think, as in each of these cases, what John has done is to say that we have other measurement bases which will do the job. Therefore, these are redundant concepts. We don't need to retain them. So we've taken our thinking forwards. And I think that's been done in each of the papers from a public sector lens. So, John's done it in a very structured way, which is to say, well, did the ISB see a need for this? And has then moved that argument on to say, well, is there an additional argument from the public sector perspective? So from a due process point of view, we've gone through that argument in a very structured way, really to document the thinking. And then I think consistent with what we've said, there's a kind of overarching approach we've taken, but there's also that thinking needs to go in basis for conclusions, which is a summarized version of what we've got here, so that we have actually looked at it from the conceptual point of view and we've documented it. You know, we've really gone through from a public sector perspective that there isn't a reason to retain. Okay, Lynn.
So I was going to make a similar point to Claudia, and then just following on, I guess, really from Chris as well, it just led me to think, if we rightly are deleting these from the conceptual framework because we think that they are ultimately redundant, albeit they may be used or similarly used in inventories, but we haven't got that on our work program to update. We end up then with a new conceptual framework. Do we need to be also making it clear that we now expect this to sort of last in duration? When would we open up the conceptual framework again? Because I guess what occurs to me is we don't know in our own future work program right now when there might be a case that there might be a situation where a new measurement base might be appropriate when we look at something that we can't sit here and foresee now in the future. So did we need to manage expectations now about when we do or don't open the conceptual framework? Because we've made some decisions here about we're going to remove these bases because they're not currently used. I agree with that, but if there is a point in the future that we want to introduce a concept, would we automatically open up the conceptual framework, or will we leave ourselves hand tied, or do we need to sort of almost set out a kind of like a rules of the road about how we go forward with the conceptual framework, having done this limited scope review?
Thanks, Lynn. There's a sort of anecdotal response to that, which is that at the session in 2014, where we actually approved the framework, that question was raised, and I think to the exasperation of my predecessor, Andreas Bergman. And you know, we had that debate as should it be a living document and so on. I think you know what we've done, particularly with measurement, is we've really done a lot more work in that space, which has actually taken the thinking forward. And that's probably the argument that we need to articulate, that what we've done here is we have opened it up precisely because we've done the further thinking. And in a way, measurement is actually what we will end up with the measurement standard is a kind of halfway between the framework and the and sort of standards, but it is more detailed, and we've done a lot more work, and we've had a lot more debate with constituents. And similarly, I think if you look at what we've proposed in terms of the other chapters of the framework, you know, with the assets and liabilities in particular, actually we know that has caused us problems in the, you know, particularly in revenue. So, you know, there is, I think you know, there's a rather rambling answer to the, if we need to reopen the framework, we can reopen parts of the framework. Ross, from a process point of view, do you just want to pick that one up?
Yeah, so again, as Ian said, this same discussion happened in 2014 when the framework was created, whether they should be clear on it not being reopened or reopened, and the board decided to remain silent. But I would say that from a work program perspective, we now have a program where we go out and we ask what should be on our program. So if the board thinks something's coming up they need to address, then that should go into our priority projects along with everything else, so we can ask our constituents where we should focus our time. And that was the reason the framework was developed in the first time. So we have a non-authoritative document to help us set standards. So if we decide to do a lot of framework work in the future, it's going to take away from our active work program doing standards as well. So that's, I think, from a strategic perspective, we shouldn't pre-commit ourselves to any framework work. We should wait until we come to that issue and then determine how to allocate our resources.
Yeah, if I could just add, Another factor was that we used the term building on the shoulders to characterize our relationship with the ISB, because we did work on measurement. And I think it's fair to say that the ISB, to some extent, picked up on certain aspects of that, because there was some commonality of staff involved in both boards. And certainly one of the reasons why measurement was picked out as an area we need to look at, as well as the point that Ian made about the depth of work we've done on measurement, was that we wanted to look and see at what the ISB had done, and pick up on anything in the ISB's framework that we felt we should at least analyse, look at and discuss at board level. So I do think that's quite important. I personally wouldn't see, the introduction of a measurement basis in a particular standard as a reason for opening up the framework again. But if a key global or national standard setter was to do some more detailed blue sky thinking, then we may say, well, perhaps we ought to be exposing the possibility of a little bit more work to our constituents.
Thanks. Lynn, back to you on the original point.
Yeah, I wasn't suggesting that we add it into the work programme. I was suggesting that we should be making in our communication somewhere a statement that says that we are not absolutely straitjacketed by it when we are considering new projects. If there is a new project on our work programme that potentially could introduce a new concept that might require the conceptual framework to change, we shouldn't dismiss that because it's not in the conceptual framework. It would be a sort of, so I guess it's a bit of a, do we need a state? I think we should have a statement that makes it clear that this is the framework. We don't expect it to change. If in the future a new project identifies something that may need to be changed, we would consider that at the time.
Yeah, I mean, I think we've already got that in the framework, and I think you're right that we can remind people about that in the communication that we do in terms of the results. Now, I don't want to sort of take a lot of time over the kind of the nuances of this. I think we've got a way forward in terms of how we communicate in terms of the framework. I just want to take any substantive comments back to net selling price, that would cause us to retain net selling price. Mike.
Thank you, Ian. Sorry, I have also a general one, but is linked to that what we discussed here. I totally agree on leaving out the discussed measurement basis, but I would like to recall our discussion in the March meeting where we had a statement that we should take care that measurement bases are to be defined consistently within the literature of the IPSASB board, so to say, within the framework and the standards. And when we reviewed the new draft, we came across, of course, transaction price, and then we had a discussion about at cost, because at cost is a very relevant measurement basis mentioned IPSAS 17 for PPE, IPSAS 16 for investment property. And so I don't want to change the text within the framework as it's now proposed, but it should be, or maybe worth to consider that we, let's say, give a small explanation within the core text or within the BC on the linkage of those two terms, because I would think our stakeholders would expect from us, let's say, to give the explanation here, because they would miss that central and fundamental term at cost within the framework. Thank you.
Yeah, thanks. So I think, we do need to make sure that we're absolutely clear about the reasons for the decisions and those points that you've just raised. So I think the instruction, John, will be to bring back the draft BCs reflecting the board's decisions today, and in a summarised version, the thinking that's been put into the changes in the framework. Okay, so with that, we approve staff recommendation in terms of net selling price, and we move on to the final, John, which is starting to open up the discussion on current operational value from the framework side.
Yeah. 2.4, and it's the review of responses to specific matter for comment 3, which asks for respondents' view on the proposal to include current operational value in the framework. And this was aligned with the proposal in ED 77. There's going to be considerable further discussion of current operational value this morning. That will be both by Steve and Jonathan in their presentation. They'll be alluding to the public sector specific current value measurement basis for assets. And Dave, in his analysis with Tashreet, will further be considering this. So I'm not going to go into a huge amount of detail. The paper gives the proposal, the definition proposed in ED 76, which I think we're all aware of, the value of an asset used to achieve the entity's service delivery objectives at the measurement date. There's going to be a lot of discussion as to how that should be modified going forward. We note the alternative view of Todd and the grounds for disagreeing with that definition. We note that the response on a purely quantitative level showed a considerable level of agreement, but also a considerable level of partial and full disagreement. And importantly, at paragraph 10, there are really 3 high-level themes to the consultation, three camps, if you like. And those are up on the slide. The first camp are those who, were pretty happy with the proposed term and definition itself. Some suggestions for improving it. There was a view that we should move some material from the basis for conclusions into the core text of the framework. There was a view that the framework should include illustrative examples. And I think it's fair to say staff have some reservations about both those proposals because we don't think it appropriate for the framework to go into copious detail on individual measurement, on how individual measurement bases are applied. That's the role of the IPSASB being developed from ED 77. The second camp, quite interesting. These were respondents who favoured really quite explicitly, yes, we do need a public sector specific current value for assets held primarily for their operational capacity, held to deliver services rather than to generate cash flows. However, we don't like what you're proposing on current operational value. Now, some of these favoured replacement cost, some of them explicitly endorse the alternative view. Okay, and they are largely in the partially agree category. And then there were those who were pretty firmly in disagreement with current operational value, and generally, but not completely, those in this camp supported fair value. They said, well, fair value is firmly embedded now in the literature of the public sector in a large number of jurisdictions. People are familiar with it. Why do we actually need a different measurement basis for assets primarily held for their operational capacity? Now, the board in March, I think, were militating towards rejection of fair value, but we didn't get, I think, quite as far as a full confirmation of that. And what some of these respondents said is, we acknowledge that fair value for these assets held for operational capacity, we need some interpretive material and we need some guidance. But we think that fair value can be made to work. And I think the best recent exemplar of that is a consultation by the Australian Accounting Standards Board, which I've referred to in a footnote, on how you interpret fair value in the not-for-profit sector. And in particular, what that does is it considers issues like highest and best use, and it considers issues like location, the assumptions you make about location of an asset. Now, the advantages of this, of course, are, as I've said, that people are familiar with fair value. The disadvantage from my perspective is that it's actually moving fair value quite a long way from the way in which it's defined in both our literature and the ISB's literature. And we're very aware from the work that the advice given to us by the CAG, that the CAG has said, look, it's important that you use these measurement bases in the same way as the ISB. In other words, don't take a measurement basis which is in use by the ISB and start interpreting or modifying that so that you end up with two different measurement bases. The detailed analysis of the responses is in an appendix, and I'm quite happy to take any questions about that now. But for the moment, I think I should not go into any further depth in view of what we've got coming up later this morning. Okay, so at that point, Ian, through you, I could maybe ask members who have any points they want to raise on this analysis of responses to raise those. But I think this kind of sets the scene for our future discussion this morning.
Yeah,
thank you.
Thanks, John. I think you've done a very good job there at laying out the landscape that we face. I think probably the best way forward is if there are any specific points, if members can bring them up when we get to those sort of areas in detail in the later discussion that we're going to have. And I think, that landscape is very much the reason why we wanted to take a step back at this stage, if you like, and given that what we're trying to do here is actually provide guidance that works in practice, and really move away from those sort of theoretical arguments where one person thinks this, one person thinks that, is really actually to ground this in, well, what will this really mean in practice? And so certainly in terms of the papers, staff have said, look, let's get away from the discussion about do we carry on calling it current operational value? Let's just take the definition off the table at the moment. Let's actually just ground this debate. And so I'm really pleased that, rather than have some debates about, well, the valuers might approach this in this way, or we think this is what they do, actually that we get it straight from the horse's mouth, if you pardon the expression. So what I'd like to do at this stage is formally welcome our two colleagues to the table. So Jonathan Fothergill, who's joining us by Zoom today, both, and then Steve Choi, who's here with us in New York. Both colleagues have extensive experience, both in terms of practical valuation, but also of working from the professional standards side and the implementation of professional standards. And I think that's really important, that we hear from them as professionals in their area, and that we as professionals in our area really actually understand the way in which they would approach these issues, and therefore what information are they producing, and how does that relate to what we already have we have in ED 77, and how we take those discussions forward. So I think probably at this stage, without further ado, what I'll do is pass over to the two of you. I understand in the presentation there are points where you will pause and ask for questions and clarification. So I would urge members, please do take this opportunity to really ensure that you're absolutely clear how they're approaching these issues, because we really want to ground our future discussions in that practical understanding. And I think both Jonathan and Steve are going to be available for the rest of our session this morning. So after we've gone through the presentation, we will then move into formal discussion of the papers. But again, I'll try and draw them in when we actually start the discussion on each of the sessions for the valuation perspective, and then they can intervene alongside members during the discussion if they feel that something's not quite clear, or some of the assertions being made are not quite correct from the valuation basis. So I'll shut up at this point and pass over to you. And I'm not sure whether it's Jonathan. You're leading, are you? And we're supported by Steve. And I should also just mention both of them have supported the measurement task force discussions at various stages. So thank you very much for that. And over to you.
Okay, thanks very much, Steve. Good morning, ladies and gentlemen, and thanks very much for this valuable opportunity to present to you all this morning, and good to be with you. So I'm Jonathan Fothergill here in the UK, and my colleague Steve Choi is with you in the room, both of us representing RICS. Clearly there are significant overlaps, common interests and synergies in our related work between the accountancy and valuation professions, and also between our own organisations as standard setters. So we're very supportive of initiatives like this morning, which enable us to discuss common areas of interest and emerging issues. So by way of brief introduction, I work within RICS's global valuation team as a senior specialist. As well as being an RICS staff member, I've also been a practicing member all of my career. And I've specialised in the areas of real estate, investment brokerage and valuation, and worked here in the UK and spent large periods of my career overseas. As you mentioned earlier, over the past year, I've been pleased to provide input as a valuation specialist into your own task force, and we really welcome this cooperation between RICS and yourselves. I'll just pass you over to Steve to introduce himself personally, and then I'll run through the agenda for our presentation. So over to Steve, and next slide, please.
Thanks, Jonathan. Hello, everyone. Again, my name is Steve Choi. Maybe a little bit about my background. Before I joined RICS, I was a valuation professional for about 17 years. Majority of the time, we were working with two of the Big Four accounting firms, specializing in all types of valuation work, and even including the audit review process. Just a little tidbit, because I was having a side conversation early on. Most of my career has been here in New York City, so so I've been very fortunate to work for global firms and got to see other parts of the world. Otherwise, I'd be pretty boring just being in New York City. But the other aspect is I've been with the RICS now for 8 years with the professional standards team. And my role is expanded a little bit now to go beyond my previous role. My specialty, I should also say, was in business valuation and tangible assets. So all the valuation professionals like Jonathan and I all tend to specialize in certain asset classes. So my area was businesses and intangible assets. And again, I've been now with the RICS for 8 years. So Jonathan, if you want to go through the agenda.
Yeah, thanks, Steve. Next slide, please. So this is our agenda for our presentation, and it's divided into 5 distinct sections. So first, I'll pass to Steve, who'll kick off by running through a short introduction to our ICS and our activities and provide some thoughts about the importance of robust valuations. He'll then talk about the valuation process, the skills a valuer requires, and highlight some of the ongoing trends we see within the valuation space currently. Steve will then pass the baton over to myself, and I'll talk about some of the important reasons why the valuation and accountancy professions need to cooperate closely. And as part of this, I'll inform you about some projects which our ICS have collaborated on. Then, given your organisation's interest in the public sector and your ongoing current operational value measurement project, we thought it would be useful to share some of our current perspectives relating to public sector valuation challenges and share with you some of our own experiences from our work in these aspects here in the UK. Time permitting, we'd like to finish off by walking through a case study of a public sector valuation. So as was mentioned earlier, we're keen to make this session as interactive as possible. We'll pause at 5 stages throughout and invite questions as we proceed. So without further ado, I'll pass you back to Steve to introduce our ICS. Next slide, please.
Great, thanks, Jonathan. For people who don't know about RICS, so just a real brief history or just a little bit about RICS. It's we are a professional body founded in 1868, so we're over 150 years old, and I think we've been around for this long of a period because we've been able to evolve through market demands and needs. The RICS stands for the Royal Institute of Chartered Surveyors. So basically, we still have some chartered surveyors, or I should say surveyors, but that was our origin. A lot of our members were land surveyors, but now we've moved on to other areas as well. And I think during this time, the valuation profession is seeing some interesting challenges, and I think there are also opportunities. So topics like ESG and sustainability, data and technology are going to have to be factored in by our organization and similar types of organizations, especially if we want to be around for 150 years. Jonathan and I may not be around, but I think the hope is that the organization will be around for another 150 years. We were created as our charter as to really protect the public interest. A little bit more about RICS is that we have 22 different pathway groups. The majority of our members tend to be in valuation, construction, infrastructure, and property management. We have over 130,000 members across the globe. Within the valuation sector, we have about 30,000 valuation professionals in over 130 countries. They specialize in real estate, both residential and commercial. We also have business valuers and tangible asset valuers, machinery equipment folks, and financial instruments. The one group I failed to include was the personal property, arts, and antiques group. We do have quite a number of professionals in that sector as well. Financial reporting tends to be the second highest type of valuation that our valuers tend to work on. So it's only second to secure lending valuations. Next slide, please. So this is our presence in terms of membership globally. Currently, 2/3 of our membership come from the UK. Not surprisingly, the UK has been around for over 150 years. Although we do have significant presence also in Asia Pacific, Europe, and the Middle East, North Africa regions as well. The Americas region for us is actually an emerging market. We've only been in the Americas market for about 20 years. So relatively compared to the other regions of the world, never thought Americas would be considered an emerging market for us, but we are. But we have invested significant resources outside the UK in terms of our staff. Roughly 50% of the staff now sit outside the UK. So there is this effort, and a lot of it has to do with the demands of the marketplace that they're, hoping professional bodies like us can support the profession. Next slide, please. So here, we just want to touch on the credibility or the importance of, credible valuations. As you can see, valuations are done for a multitude of purposes, either financial reporting, transactions, litigations, and tax reporting. A lot of the professional advisors are also involved in valuations. You'll see, won't read through everything, like financial advisors, accountants, auditors, fund managers, tax attorneys, as well as valuation professionals. We do valuations for corporations, financial institutions, governments, and we put in regulators there because there's a tendency that valuations are scrutinized by regulators. So really the key for these credible valuations is the consistency in terms of methodology by the valuation community. And I think it's important when methodologies are not used, then there's an explanation for a rationale why the evaluation practitioner deviated from that common practice. Transparency is also, I think, an important issue here is about the openness of the valuation procedures used, as well as some of the key assumptions. And the supportability is another item that I know auditors, sometimes really challenge valuation work because they can't audit certain assumptions. One of the assumptions I was talking earlier with some of the staff was that, as an audit reviewer, when I was working for the Big Four, sometimes valuers would put in their reports that this assumption is based on 30 years of experience. So from an auditor standpoint, even from another valuer reviewing it, they can't audit, that type of number because it's not really quantifiable. So I think it's important that when valuers when they perform valuations, that all their assumptions are supported by quantifiable support whenever possible. Next slide, please. So real quickly, I think most people probably understand this, but I think valuations undertaken in accordance with generally accepted principles are essential to financial stability, and for financial reporting is also key, and most valuers do follow the appropriate accounting standards. Back in 2008, the valuation profession was also criticized, as well as a lot of financial institutions, for basically a poor valuation practice, and valuers basically contributed to the 2008 global financial crisis, according to the Financial Stability Forum, as well as the G20, basically criticizing valuers for overvaluing certain assets within mortgage loan companies such as Freddie Mac and Fannie Mae as well. Again, touching upon the importance of reliable and consistent valuation is of fundamental importance to regulators and market participants when it comes to determining the capital adequacy of financial institutions. And most companies, whether they're audit firms or valuation firms, valuations are a fundamental part of the risk management process applied by financial institutions and businesses as well. Next slide, please. Let's just pause now for real briefly to see if there's any questions, whether it's questions about us or just in general about the high-level approach that valuers take.
Okay, thanks for that, Steve. And I think that's very helpful to give us that context that, that the breadth of the activities, but also the importance of global professional standards there in credibility of the work. So open up for questions from members at this stage. Okay, we're good. Thank you.
Okay, sorry about that. Recently, we just went through a review of our strategy. It was a public document that was actually released yesterday, and it still talks about our core, why we were created and why we still need to exist is really to protect the public interests. We also enforce that our members follow these professional ethical standards, and basically from a trust and confidence standpoint, Jonathan mentioned we are also a standard setter, but in a lot of markets we also basically quality assure a lot of our members to make sure they're adhering to these standards. And in some markets where we don't regulate, we basically regulate professionals to making sure they maintain their, their qualifications or expertise through education. You go to next slide. So the RICS Global Valuation Standards, also known as the Red Book, just because it's red, it's been around since 1976. It's been translated in different languages, and in a lot of the major economies, we have national supplements or jurisdictions guides, which provide advice on the application or adoption of our global valuation standards. It's also been adopted by other organizations. There was an organization in Saudi Arabia, as well as a Nigerian organization that have adopted the Red Book. The Nigerian organization basically took our Red Book, translated it into the language, and then they put the color green on it to symbolize their colors, and they call it the Green Book. But in essence, it's basically our Red Book, just translated. We're also currently in discussions with other governments. Jonathan's involved with some of those discussions in the Mideast about certain countries also adopting the Red Book as well. It's recognized by a lot of the key stakeholders globally, whether it's not just government, but also valuation firms. And although in certain markets, they do have other valuation standards, our valuation standards allow for flexibility. So if a member is following the appropriate or relevant standard in their particular country, they are also in compliance with the Red Book. So even if they're doing a valuation for IFRS purposes, valuers need to follow the appropriate standard when applicable and appropriate. So this is this valuation process is really the same for all our valuers performing valuations, whether it's for real estate, businesses, or financial instruments. It really starts with basically the client requests a valuation, and it goes through all the process, whether it's to include understanding the relevant basis of value, the valuation approach, and all the analytical techniques and modeling as well, and then establishing a report. I'll talk a little bit later about the reporting aspect when I cover the compliance on the next slide. But I think valuers today, in addition to submitting or reporting on their findings, I think there is an expectation as clients become more sophisticated that valuers also need to provide strategic advice as well. So if you can go on to the next slide, please. So this is a list of some of the competencies that a valuer is typically required to have. And I'll just quote from the IVSC about the role of a valuer. An individual or group of individuals or a firm who possesses the necessary qualifications, ability, and experience to execute a valuation in an objective, unbiased, and competent manner. And I think that's important because, regardless of who does the work, even if as a valuation professional, they can't do it all. There are different asset classes, there are different industry sectors, there's even local relevant laws that just because you may be, a great valuer here in the US, you may specialize in financial reporting or tax reporting, but that doesn't give you the expertise to do evaluation for UK tax purposes. So I think having that competence is, these competencies as well as understanding the local laws are very important as well. I think you go into the next slide, please. So I touched on this, that this is, and it really goes beyond AVMs or automated valuations. It's really emerging technologies. There's so much emerging technology, and even, technologies like cryptocurrency, things like data and technology, a lot of data companies out in the marketplace. I think valuers are probably behind in terms of competencies in this space. So this is having an enormous impact on the valuation profession. And I think valuers need to embrace this technology, but also understand how these tools can help you. There's a view that automated valuation professionals could replace valuers. That may be the case, in the future, whether there's AI or robots to replace valuers, but there's still the professional judgment element to it that I think, automated valuation models won't be able to do. Especially during the pandemic, I'm not sure the models were capable of understanding the impact of the pandemic on particular assets. We have an initiative to incorporate what we call automation, which also includes AVM competencies into our valuers. So we're probably, we probably should have done this a few years ago, but I guess someone could say it's better late than never. But I think it's important that valuers need to upskill. And I think this type of competency will make the profession more attractive. I know the audit profession probably went through a similar challenges probably about 10 years ago when they were faced with potential automation or impact to technology. And I think the audit profession has done quite well to embrace the technology and also adopt the technology as well. From what I hear that, I know David's smiling, but I think from what I hear, the accounting schools here in the US are all up in attendance. So there's a large, enrollment for younger students going into the accounting profession. It did drop off several years ago because I think there was an expectation that perhaps AI or robots would replace auditors. And it's replaced some of the work, but I think it's made a higher level work for the new auditors. And we can discuss that further. So other trends in evaluation, we talked about ESG. It's really important that we incorporate ESG factors into our evaluation, especially today. This slide talks about a recent guidance note we published. It was really for the commercial property valuers. We also are part of a working group with other professional bodies, including the International Evaluation Standards Council, and coming up with key environmental issues that affect enterprise value. And early on, I'll just tell you that it's interesting, and even in engaging with the banks, the investment banks, there aren't really consistent factors they use to assess decisions, investment decisions. So this, I think, is a great initiative to have that dialogue and discussion to come up with these environmental factors that impact enterprise value, and obviously enterprise values will carry over to the assets as well. We've had discussions with the IFRS Foundation staff, or really specifically the VRF staff, about the two proposed standards on general sustainability related disclosure requirements, as well as the climate related disclosure requirements. And we will also respond to their consultations. But I think these two standards will have the potential to be material to our valuation professionals. They need to understand that, because I think they're going to have to report that information or any advice they can give to their clients alongside valuation information today. And finally, on the next slide, before I turn this over to Jonathan, about a year ago, and this is a major project within the RICS, and probably, we'll go beyond the UK and perhaps other asset classes, is that we received criticisms from market stakeholders about the independence and objectivity of valuers, along with criticisms whether valuers or their valuations are keeping up to pace with market realities. So our Standards and Regulation Board basically commissioned a working group to do a review of our valuation offering. And this past January, they came up with 13 recommendations to ensure that valuations remain fit for purpose. One of the recommendations that we're talking about is for our commercial real estate valuers to consider adopting a discounted cash flow analysis in their work. Whether it's a primary method or one of the methods to use is they should be considered in their valuations. Some of the other things they're looking at is looking at property risk analysis, basically a forward look, really to ensure that the valuations give clients sufficient information about the risk about a particular property. And then obviously during this time, there's also recommendations with respect to culture, behavior, and diversity. So DEI, I think the valuation profession, especially here in the US, is certainly addressing, but I think this is a global issue and not just a local issue. So we need to address that, and not just from a gender perspective, but across everything, whether it's sexual orientation, racial, ethnic backgrounds and religions as well. So next slide is, again, I'll pause here for any questions, comments.
Thanks very much, Steve. I think it's really interesting to hear how the same pressures that we see on our profession are shared by the valuation profession, and certainly the area of sustainability reporting, is one where we've got a consultation out at the moment, and it certainly will, I think, be useful to continue the dialogue as if we move into that space of the public sector. We're proposing that we would move forward on, using the IPSASB's two exposure drafts as potentially the first two areas for our work. So I think that's very useful. Now, I've missed whose flags went up first. So I think what I might do is take Scott first on the screen, and then I'm going to move around the table, just then go to Todd, and then Lindy, and Claudia, and then Thomas.
Thank you, Ian, and Steve, thank you for your comments. Being that you reside in New York and the American Institute of CPAs is down the street from where you are, could you comment, and they have their own set of standards, evaluation and credentials. Could you comment a little bit about consistency? You talked about people adopting the standards that you have, but there's also other ones out there. So could you comment about consistency across the various standard setters in this area? Thank you.
So, yeah, so I will tell you that, so the Red Book basically incorporates the international evaluation standards. I also know as a fact that the AICPA is also considering the IVS as well. I think even prior to them considering the international evaluation standards, there's been a general movement overall for all valuation standards to converge. There's been a project between even the IVSC, which is the International Valuation Setter. And then there's in the US, the Appraisal Foundation that also sets valuation standards for the real estate group. They've been working on a convergence document for several years, and each time each organization releases their updated standards, they're moving closer and closer together. So the AICPA, their business valuation standards are, I think there was an organization a couple of years ago that you may be familiar with that basically put all the standards side by side, including the international valuation standards. And the general conclusion was a lot of the valuation standards are consistent across the board. A lot of the differences really have to do with terminology. Even between the US and UK, it's amazing. They say that two great countries are separated by a common language. It's the truth. Because sometimes I don't quite catch, I work for a UK company, but I don't catch all the nuances, what people in England always say. And they probably don't catch what we say as well. But there has been a lot of convergence in valuation standards. And when John was talking about his project, I know, I didn't want to jump in, but I wanted to commend the fact that this group is also aligning with other accounting standard setters, because as a practitioner, when accounting standards tend to differ, it causes problems for clients. I remember years ago, when there was a business combination, when IFRS and US GAAP, and now this is going back more than 10 years ago, so I'm dating myself here, were different. Valuers are required to perform valuations for two sets of accounting standards, and they were different, and the values were different. From a client standpoint, they couldn't understand that. So I certainly wanted to commend the fact that when John mentioned IASB, it's great to align with other accounting standards. So going back to your question, I think for valuation standards, they are becoming more and more aligned. The one thing you might also find interesting, a few years ago, actually right about the time I joined RICS, both the AICPA, RICS, as well as another professional body were involved with this credential called the CEIV, the Certified in Entity and Tangible Asset Valuation credential. All three of us developed the credential and issued the credential. And it's, in short, basically, it was created in response to criticisms by the US SEC about basically criticizing the valuation profession for a number of things. It's basically valuation experts not having the expertise to do the work. There was no consistent basically process in terms of the qualification. So we have worked with the AICPA, and I think we'll continue to work with the AICPA. I also know that they are considering the IVS standards. I'm not sure whether they'll adopt it, but they can probably provide some guidance to their practitioners to ensure that their standards become more aligned internationally.
Thanks. So what I'll do now is I'll just collect around the comments from the members in the room, and then back to you to sort of respond to those. So if I just go around the table, so Todd first, then Evie, Adrienne, then Claudia, then Thomas.
Thank you, and thank you for the presentation. It was very helpful. My question relates to public sector assets. I'm very much thinking about the public sector assets, and those assets tend to be quite specialised, and they're there to deliver on, the service objectives of the entities. And I'm just wondering how a valuer goes about valuing that type of assets, given that, it's not like there's market cash flows that are associated with those sorts of assets. It's very much about the delivery of the services.
Yeah, it's a good question. I think we have a case study that will cover that. So Jonathan's going to cover that case study and go through one of the examples. So perhaps after he presents the case study, if you still have questions, we can discuss again.
Okay, so Evie, Adrienne, and then Thomas.
Thank you, Chair. Thank you for the presentation. My question is about the authority of the standards that you develop and issue compared to those, and probably meets Scott's question. It happens that there's a lot of companies, valuation companies, who try and group themselves to develop common standards. And in the end, you talk about international business valuation standards or international valuation standards. But what is the authority of those standards? Who issues the international business valuation standards? If compared to a board like IPSAS, the authority of the pronouncement and standards comes from the broader adoption of the standards. It has no authority per se. It only derives from the adoption of the standards. So if each and every valuation company issues its own standards, now one could believe that the standards will not be adopted globally. And what's the process for having a convergence of all these standards into a global, internationally recognized set of business valuation standards? Because I've heard of the European Business Valuation Standards Board. There's a European, it's an association of companies themselves that are grouped in the what they call the TIGOVA. But in the end, how does it position compared to what the US could do or the Asians could do?
That's a great question, because I think valuation standards are really dependent on the stakeholders, the firms adopting standards. And a lot of the firms, having worked for several of the big four accounting firms, are really cautious about adopting a valuation standard, and they won't say that the valuation standards are in compliance with IVS or a particular standard unless legally they're obliged to follow a local standard for a particular purpose. If you're in Hong Kong and you're doing evaluation for the Securities and Futures Commissions, there's an expectation that your valuations have to comply with a particular standard. But going back to your question, it really depends on the firm. So one initiative that a lot of the valuation bodies are discussing is with IOSCO, the International Organization of Securities Commissions, about adopting a particular standard. And the standard that even for RICS, we want to push is the International Valuation Standard. So create some commonality between organizations and stakeholders. So I don't know if, I won't say how much of the inconsistencies are created by, varying international standards or valuation standards. I'm sure it does contribute to that. So having some type of consistent framework, I think, would be very important, even between the USPAP here in the US versus the IVS. I would say a lot of it has come together over the years, but there's still some differences. And like I said, going back to that example of IFRS and US GAAP, 10, 15 years ago, there were those differences, but through the years they've merged and they're, I think, generally pretty close in terms of how valuations are being used for those valuations. Maybe leases, there's still some varying differences, but for the most part, they're very close. I think the valuation profession is probably still behind in that regard because of the different standards. And it really depends on the firm. So when the gentleman on the phone mentioned the AICPA, not everyone's an AICPA member. I think they have roughly, don't quote me on the numbers, but roughly 5,000 of their members. But they also work, some of them work for different valuation firms. So if a particular valuation firm says they need to be in compliance with IVS because they made that choice, the valuation firm needs to follow that. If you have sole practitioners that are AICPA members, they'll follow their particular standard. So I think, as more and more organizations are coming to the table and having those discussions with the regulators, and I think the regulators have been instrumental in pushing for consistency. So I think that's important as well.
Thank you. I think that's helpful to understand that sort of emerging picture. But I think from this point of view, then it becomes important if as we've got with the draft implementation guidance, then that actually does relate into standards and methods and so on that would be relevant internationally. And we'll obviously get further into that, but I think that was a very good question, Adrian. So in this round, I'll just go to Thomas now.
Yeah, thank you, and thanks for the presentation. It was really very helpful to understand what you're doing. Just a follow-up question, probably on the question of Adrien. I think you talked about the criticism towards values regarding independence, objectivity, professionalism. Kind of the authority and consistency of standards is one thing, but the compliance with the standards is the other thing. So kind of my question would be, what are the quality assurance measures within the profession to kind of make sure that these standards are complied with? Is there something like a peer review of value companies amongst themselves, like we have it in the audit practice? What are mechanisms to assure quality?
Yeah, so the project I mentioned, the CEIV credential, try to accomplish that, but the reason why probably it hasn't landed is because the credential is voluntary. It's not a mandate. I'm not sure the firms are going to mandate it. I think we were hoping for that, and that would certainly help with the quality assurance aspect, especially here in the US. The valuation profession does not have the peer review process like the audit firms. And I don't want to get into detail, but there are various reasons why the valuation firms don't want to adopt that type of process. And I think there's a challenge there because they don't have an regulator like the PCAOB here in the US and other types of regulators. So, valuation professionals don't have a securities regulator or government regulator to ensure they're following some type of process. So RICS does have its own form of quality assurance program where, not here in the US, I'll make that clear, in the US, what we call that value registration or the quality monitoring assurance program doesn't exist in the US because there's just a lot of pushback from firms here. But in other markets, it's more widely accepted where we would do a review or inspection of the files. So, but even with that, I'll caveat that it's limited because if you're trying to review a valuation performed for a public company because of the confidentiality laws, we can't get access to those work papers or work files. So some of that, I think working with regulators will allow for that. So, I think this initiative in talking to IOSCO could potentially help with that because if they do adopt IVS, they're thinking more broadly about professionalism and that would also include the regulatory aspect because the valuers, the only thing they have is for financial reporting where if you're doing a valuation for an audit firm, for an audit client, for financial reporting purposes, usually that audit clients has specialists who will review the work. And that's the only, I guess, form of, some type of peer review they have. And, they don't have any type of other securities or regulator monitoring the valuations. So certainly, I think we're keeping an eye out on the IOSCO. They're, hopefully, first step is to get maybe international valuation standards in place, and then the professionalism will come in afterwards.
Thanks for that. I mean, those international pressures are certainly what has caused a lot of, increasing pressure in terms of independence, professional quality, and so on within the accountancy profession, and even pressures in terms of separation of audit practices from advisory and so on. So I think you can look forward to further pressure in that respect in terms of, and I mean, I think IFAC itself has statements of member obligation, which are, enforce ethical standards and so on. And certainly having myself been responsible for the disciplinary scheme for one of the professional bodies, that, I mean, it's quite an intensive process, but I think very important in terms of the ability to investigate complaints against individual members and actually review that in an objective way. So those processes, I think, become very important, and enforce adherence to standards. Mary.
Thank you so much. My question is so simple and fundamental. So there exist so many environmental factors that affect the valuation, and so so many difficulties in to apply the standards in so many cases. So what about that?
So could you just repeat that question?
So many environmental factors, various environmental factors exist, and so it affects the standards, and so many difficulties in applying.
So, regard to environmental factors, I think that's a great question, because I think the IPSASB is trying to get that feedback from the marketplace. And I had alluded to it earlier, but basically, we're working with a number of other stakeholders. It's just like the professional bodies, but also people from the valuation profession, to understand some of those key environmental factors. And this goes beyond maybe just green buildings, but it's about waste disposal. It's about emissions. It's everything. Like here in New York City, in 2024, buildings are going to have to comply with certain emission standards, otherwise they face penalties and fines. So, right now in terms of environmental factors, I'll just say that there aren't really. I don't think there's consistent standards, because we've also engaged the banking community, and the banking community, what we're hearing is that they don't really have consistent standards in terms of how they evaluate enterprise value. So we hope that this working group, will come up with some, framework that we can share with the IPSASB as well as other organizations. And I think if we can come up with a framework, we would, certainly use that as a as potential framework for other market participants to use as well. So I agree, right now there aren't any factors, and the IPSASB is looking for that as well. So
Thanks. Yeah, I mean, I think it's clearly going to be a rapidly developing area, certainly if the pressures to move quickly are anything like those on the IPSASB, that's going to be a debate that's going to need to happen very rapidly. So at this point, I think we're at the first break. So I'm going to suggest that we break at this point for 20 minutes, and then we come back, and then we'll carry on with the next stage of the presentation, if that's okay. Okay, and David, as ever, will keep time. Okay, so we now move into the third segment of the presentation, and I think, Jonathan, this is over to you.
Yes, thank you.
Okay.
So I'm going to talk at this stage some more about valuers and accountants cooperating with each other and the importance of the two professions working together. It's obviously important that both accountants and valuers do work closely together because there are significant overlaps and close synergies shared between us, particularly in the areas of financial reporting and auditing. It's also important, of course, to ensure global valuation standards are consistent with global accountancy standards. So just as per the slide I have up now, and as a personal illustration of this cooperation, I've recently overseen a working group consisting of accountants and valuers, and we work together to provide some guidance for the RICS members relating to IFRS 16 implementation, which is now adopted here in the UK public sector. Moving on to the next slide, please.
Jonathan, if I can just interrupt for a second. There was a question earlier about some of these accounting standards fitting into our valuation standards. And I think a lot of the work that this board and group has done, when it's final, the measurement standard, if we can also do the same thing like IFRS 16, like other accounting standards, whether it's IFRS 3 or 13 or whatever else, is to incorporate these standards within our valuation standards as well. And I think that would answer some of the questions about the authoritative nature of our standards. So, certainly I think we will do that just to give guidance, because as Jonathan and I found out, financial reporting does make up a good portion of our work, and we have a large group that does public sector valuation work, which probably if you asked me 2 years ago, I was not aware of that until we did our study. So it is a big piece of our work for our valuers. So I think once your standard is up and running, we would connect it to our valuation standard.
Thanks. I think that would be very powerful, and it certainly would address a number of the points that members were raising about authority and consistency and so on. So Jonathan, over to you then.
Thank you. So on this slide, I've just put up some of the ways in which valuers and accountants can assist each other. So we can do this by providing input and helping with each other's standards projects. We can include staff on the other's projects in the same way I'm currently a member of your own task force. We can inform each other of diversity in practice, such as in fair value measurements. And finally, we can inform each other of emerging issues and come together like this morning to discuss. Next slide, please. So in this slide, we set out some of the key financial stakeholders RICS cooperate with and some of the financial reporting projects which we've been involved in. Steve's obviously touched on some of them earlier in the presentation. One of our key outputs is obviously to work closely with the International Valuation Standards Council, which we're a member of, to develop our Red Book Global Valuation Standards. And these are adopted for all of our members around the world. IOSCO is an important stakeholder which RICS has cooperated with. We've promoted our consistent and global professional standards to promote investor confidence in the integrity of the securities markets. In our day-to-day work, we cooperate closely with the senior valuation personnel within the major accountancy firms who are RICS members. And these personnel are oftentimes important members of our technical working groups, inputting on our own standards. Of course, our members are working on a day-to-day basis in tandem with the auditors as their valuations are being reviewed during the auditing process. So there's constant dialogue going on between the two professions in that respect. Other key financial reporting stakeholders who we cooperate with include IFRS Foundation and, as Steve mentioned, the International Sustainability Standards Board, which has recently been created. We work with the Institute of Chartered Accountants of England and Wales here in the UK. There in the US, the American Institute of Certified Public Accountants. And in the Asia Pacific region, we cooperate with the Hong Kong Institute of Certified Public Accountants and the Chartered Accountants of Australia and New Zealand. As I mentioned a few slides back, we have been involved in improving our members' knowledge of IFRS 16 and inputting on the mandatory performance framework for fair value measurements. Next slide, please. I'll just pause there to take any questions on what I've just run through.
Any further points at that stage? Okay, thanks, Jonathan. So move us forward.
Okay, so I'm going to talk now and focus some more on public sector measurement challenges and share our views on what these challenges are in the public sector valuation space, some of which are particularly relevant to your current operational value project. The primary objective of most public sector entities is to deliver services to the public rather than to make profits and generate a return on equity to investors. So the type of assets that public sector entities hold is likely to reflect this objective, and assets are held much more frequently for their service potential rather than their ability to generate cash flows. Because of the types and services provided, a significant proportion of assets used in the public sector are specialised. So examples may include road network, nuclear power stations, hospitals, and so on. A common concern with fair value as a basis for valuation is that when an asset is held for its operational capacity, fair value is difficult and inappropriate to apply because certain concepts are generally not applicable. So such concepts would include highest and best use, and secondly, maximizing the use of market participant data. So consequently, this may make the application of fair value difficult in a public sector context, not only to calculate the value, but also to interpret the result. As part of my role with your own task force, I've been involved in discussions relating to your current project concerned with deriving a public sector valuation basis, which you're terming current operational value. So as part of this, I'm able to share our perspectives and experience from various issues currently arising from valuations predominantly here in the UK public sector, and which I'm in the process of tightening up guidance on in my role with RICS along with my own task force. Next slide, please. So here in the UK, the Central Government Financial Reporting Guidance, known as the FREM, states that assets held for their service potential should be measured at their current value in existing use. And I've put a definition of this up on the slide. So this definition starts off very similar to market value, but halfway through adds, assuming that the buyer is granted vacant possession of all parts of the asset required by the business and disregarding potential alternative uses and any other characteristics of the asset that would cause its market value to differ from that needed to replace the remaining service potential at least cost. The UK public sector adopted existing use value as far back as 2002 as a basis of valuation for public sector property used for service delivery, alongside IFRS fair value for most other public assets. I find there to be a lot of similarities with the issues and concepts arising from existing use value and what you yourselves are seeking to address within your own current operational value project. I know amongst your June papers that you're considering the concepts of existing use, surplus capacity, and existing location. What I know in particular is that your COV project is having regards to the key principle of existing use. So valuing the hospital as a hospital and not an office, for example. You're focusing on valuing the physical asset and not valuing the service it provides, and valuing the entire asset, so not just what is being used. And related to this, providing guidance on how to deal with surplus space. And you're also being concerned with the existing location where the asset is situated. Next slide, please. Sorry, just before we come to the questions, I'd just like to add that I think it's very useful that you're giving specific consideration early on in this process to some of these key concepts, because differing interpretations in the UK of some of these aspects are giving our valuers and auditors real issues and leading to inconsistency in application. What we find in the UK is that because existing use value is much less widespread, the body of knowledge around it has diminished, and we've seen examples of where it's misapplied, misunderstood, and misrepresented, both amongst practitioners and academics. So to address this inconsistency in EUV's application in autumn last year, on behalf of RICS, I'd formed a working group consisting of valuers, auditors, and various stakeholders tasked with producing fresh explanatory guidance on EUV. An immediate question which has arisen in our working group is whether the prevailing measurement principle of value to business, as set out in the original 2002 EUV definition, remains valid and fit for purpose. And is this still what Her Majesty's Treasury require in what is otherwise an IFRS market value financial reporting environment? So from our work today, it would appear that it's the interpretation and practical application of service potential that has given valuers the most difficulty in interpretation, more so given that this is a concept generally better understood by accountants than valuers. Other issues which we've had flagged within our workshopping has included differing interpretation of vacant possession, included within the definition. Are valuers valuing the actual property in use or a different property situated in an alternative lower value location? And where is it appropriate to draw the line between what qualifies as a specialist as opposed to a non-specialist property? So in conclusion, I think in a situation like this, it's really key for valuers and accountants to be informing each other of diversity in practice and working together to seek solutions. Next slide, please. So I'll pause there now to take questions on what I've just ran through.
Thanks, Jonathan. And I think it might be helpful if we could just go back to that previous slide, because I think there's a number of things that are obviously very relevant. Perhaps I might just take Lynn first, because obviously as chairman of the Financial Reporting Advisory Board in the UK, you have a perspective on it, and then I'll go to Todd.
Oh no, you've now made me declare my interest. Obviously we've got it right in the UK, haven't we? I just thought it might be helpful, Jonathan, just to say a little bit more about how you decide what's a specialist asset versus a non-specialist, and just clarify, if it's a non-specialist asset, how does that affect the valuation? Do you still use this basis, or do you go to a fair value under IFRS?
Well, in answer to that question, I mean, specialized asset is defined by the Red Book glossary. So it's defined as being a property that's rarely, if ever, sold in the market due to the uniqueness arising from its specialized nature and design, its configuration, its size, location, or otherwise. So these are the various elements in which we determine whether an asset is specialist or not. In terms of the UK public sector, existing use value is applied to operational properties, be they specialist or non-specialist. Investment and surplus properties generally covered by IFRS. So non-specialized properties, relatively straightforward in terms of valuation. Specialized assets become a bit more subjective, and depreciated replacement cost as a methodology is generally used to value many of these types of assets.
Okay, thanks. Ross, did you want to come in specifically on that, or do I go to Todd next? Okay, Todd, to you.
Thanks, Ian. Looking at this definition, I am sitting here wondering why we are using a basis like this for public sector valuation purposes, because from what I'm reading here, it's creating a notion of an exchange of an asset. So it's saying, you know, we're going to be selling the asset. In the public sector, we tend to have assets that are quite specialised that we need to deliver services. So why would we be thinking in terms of selling an asset and using a valuation base for public sector assets? I'm just struggling with this as a concept for valuing public sector assets.
Yeah, I mean, it's a fair question, and I think its introduction in the UK was back around 2002, and it was introduced from the private sector. And just looking into the history of it, I think it almost came about through accident, and it's carried on really throughout the past years. And valuers do struggle with understanding the hypothetics of what the definition is getting at. And what I see the definition as in a nutshell, or what it is expecting a valuer to do, is to envisage a hypothetical owner-occupier purchaser in the market at the valuation date, and who will buy the property at that date, stepping into the shoes of the existing owner-occupier and carrying on delivery of the same business function in the same way. That's my own interpretation of what this definition is getting at. But in the absence of much guidance in the UK, it is causing auditors and valuers quite a few headaches, and it's currently the subject of a thematic review by Her Majesty's Treasury, and this review is generally considering other options to current valuations, such as historic cost, reverting to that once more. Just by way of background to this review, here in the UK, there are many issues around the auditing process in the public sector and significant delays. So the government's urgently looking for solutions, and reverting to historic cost is possibly one of them. As part of this inquiry, also, it's looking into the whole importance of valuations and how useful they are ultimately to end users, given the significant effort and cost of the whole public sector valuation process. So my work group is concerned with all of these aspects coming out of this definition and the various subjectivities, but there is a bit of a wider picture as well currently.
Thanks, Jonathan. And I think it's worthwhile noting that the real issue that's causing concern at the moment is actually over the valuation of roads, and the fact that a lot of the network came in at a value of the existing loan debt. And that's actually really what's caused the problem, rather than necessarily, okay, it's opened up a question more widely, but actually it's that specific thing, and the auditability of values that came across in the 1990s into the books. So it's a specific technical issue rather than anything. But Todd, you wanted to follow up?
Just wanted to clarify that this existing use value as defined here, this is only something that is used in the United Kingdom. It's not part of the international literature. I just wanted to understand that.
It's not something I've come across overseas, Todd, in my experience. I believe it's to be UK centric.
Okay, so I think I've got Ajith next.
Thanks, Ian. I want to find out looking at there can be two types of assets that probably a public sector entity can have. One is the specialized assets, which can be used only for that purpose, and also sometimes we also have assets which are used for a specialized purpose, but there are also assets that can be used for other purposes as well. So, for instance, in the case of a road network, we have a situation where it's difficult to find an arm's length price between two buyer and a seller in an open market in an orderly manner, and therefore it's a little difficult to identify arm's length price for that. And I was wondering whether there are private sector similarities of similar assets and how the valuation is dealt with in relation to those specialized assets. The other question I would want to ask is in relation to non-specialized assets. For instance, we might have a hospital in the center of a city where the hospital uses the land and the hospital built on the land. We value the land separately from the building and each item of asset. When we value the land of the hospital, do we consider that land as a specialized asset, or do we consider that land as a land that can be used for other purposes as well, and whether a transaction based, that is, whether buyer and a seller agreeing to buy or sell at that price is appropriate for that land, which is used for the specialized purpose by the public sector. So I want to find out what your response is in relation to those two areas. Thank you.
Yeah, thanks for those questions, Ajit. They're very pertinent. Maybe dealing with the first one and the relevance of specialist and non-specialist assets in the private sector. Obviously, both can exist in the private sector, and the depreciated replacement cost methodology can be used as a means of last resort in the private sector. In fact, we have guidance on this in the Red Book, but it is used as a means of last resort where there really isn't a market existing and the assets are so unique. So yes, it does have a relevance in the private sector also, and we do provide guidance in that respect. Turning to your second question relating to the land element within a DRC valuation. Yes, that the land is considered not separate from the building. It is considered to be specialist or forming part of the overall specialist asset. It is very challenging for valuers in these exercises often to find comparable land evidence based on very specialist uses. So it may be a case of turning to alternative values for comparable evidence initially, and then making adjustments to that evidence to reflect the specialist use, and perhaps having regards to comparable evidence from further afield relating to the specialist use. But yes, you are right that the land element is to be considered specialist also.
Thanks for that. So I'm not sure who was next. Maybe Ross, I'll take you and then go back to Lynn if I can, and then Renee, and then Patricia.
Thanks. Just had a quick question on the definition, because I had to read it a couple times to try and get a sense of it. So I'm just trying to figure out if I understand it, and maybe it's just a question of confirmation. So when I read the first part, it's about a willing exchange in a market between sellers, but the second part then puts restrictions on it. So is it pretty much the summary of it is saying when you sell the current asset as you're currently using it to someone else who would use it in the same manner, so restricting the market, you wouldn't sell it for its highest and best use for, am I right in that? And the second part of the question I had is maybe a follow on from Todd's earlier question. So this is the UK specific guidance. Does that mean there is no IVSC guidance on this issue, or it's different? Just interested to know that.
Yes, on your first point, your interpretation is similar to mine in terms of what you're assuming in that scenario. In terms of your second point, that there isn't any guidance from IPSASB in terms of existing use value. It's from what I see a very UK-centric concept.
But perhaps just expanding that, Jonathan, for a moment. I think Ross's question was, given that we've seen that there are other sources of valuation guidance around the world, are you aware of any other body that has issued guidance on how to value specialized assets, public sector assets?
No, not in my own experience. It's not to say that it doesn't exist, but I'm not aware of a main body of work dealing with that. And I believe our ICS is at the forefront in terms of guidance on DRC methodology.
Okay, thanks. That's helpful. So Lynn, back to you, and then I'll go to Renee, then to Patricia.
So just in terms of the UK, Jonathan, when you were talking about the private sector, you said that DRC was in effect a last resort. Are you able to give a flavour of the sort of proportion of public sector assets you value on some sort of market exchange analogy versus doing a DRC methodology? Is that something that is sort of just in broad terms, just so that the board can get a feel? And while I've got the floor, there were just two other questions. You also said that service potential valuers sort of differed in their view to accountants. It would be interesting just to understand how you view service potential. And then the final one was just a comment in terms of the thematic review that you referred to. So yes, the FRAB that I chair called for a thematic review, partly because we could see there were elements of the public sector who were questioning the value to users of holding assets at valuation and the cost of obtaining those valuations, and also some concerns around elements of the public sector, as Ian has said, that didn't really have robust data to support the values on the statement of financial position. We're due to receive the outcome of that from Treasury at our meeting next week. So actually, if that is useful, I'd be more than happy to share that with the task force, if that would be of value.
Yeah, thank you, Lynn. To your first point, I mean, every public sector entity, their portfolio's quite unique. So local municipalities up and down the UK, their portfolios vary between mix of operational properties and investment and surplus properties. Generally, in most portfolios, my own experience, operational properties dominate the portfolio and would typically make up possibly 60-70% of a typical local authority's portfolio. Of those occupational buildings, the majority will be quite specialised, so that may include a portfolio of school properties, educational properties, libraries. So I would say that specialist properties do dominate quite a lot of the operational properties. In terms of the investment portfolio, they're generally non-specialised, obviously. Surplus properties often consist of development land, typically. So I think it is fair to say that, specialised properties do make up a sizable proportion of portfolios and financial reporting, and a lot of them are typically valued using a DRC approach to valuation. hopefully that answers your first point. In
Sorry,
terms
Doug,
of,
what about
sorry.
what about something like office accommodation occupied by a municipality?
Yeah, that's obviously a relatively straightforward task. It's non-specialist, and there's generally sufficient market inputs available to a valuer to be able to value those properties. And often there may be external leases in place which assist the situation. So offices is quite a routine exercise for most valuers in terms of the public sector valuations. Does that cover your first point?
And the other parts of the estate you hadn't mentioned, but certainly in my own experience that do use DRC a lot is hospitals.
Yeah, of course. Hospitals, schools, libraries, really specialist one-off properties that you typically find in the public sector. They generally dominate the portfolios.
Thanks. Lynn, what the
Service,
third point was the report,
potential.
service potential, sorry, yeah.
Yes, service potential. I mean, as I alluded to, it's not a concept that, you know, is readily apparent to many valuers, and that may be because they're not working in the niche of the public sector and they're generally working in the private sector. I think service potential obviously takes you down a different road as opposed to market inputs, and that's maybe what makes valuers a bit uncomfortable about it, trying to understand what it means exactly and how to assess it, and there's maybe a concern that it reflects a calculation of worth rather than a value. So although it's defined in Red Book in the glossary, there's no, you know, guidance as such available to valuers. So when they're coming across these valuations in the public sector, it is a challenge for them if they're not having the relevant expertise and experience in this sector.
Thanks, Jonathan. I mean, I think what you've just expressed in terms of a lack of definition, lack of clarity would echo the comments we heard as a board. Well, those of us that were here on Monday heard those expressed in the discussion with our consultative advisory group. And I think that's echoed as well in the papers. The need to explain this in order to move the debate forward. So if I can go to Renee next and then to Patricia.
Thank you, Chair. So I have two questions. One of them is related to, I'm reflecting on part of the definition and how it would apply to an asset that's used, well, let's say a school to deliver a service, but it's housed in a heritage building, for instance. So the part of the definition that says, and disregarding potential alternative use and any other characteristics of the asset that would cause its market value to differ. So does that mean that we would value the asset as a school, right? Used as a school in my example. How would you consider the fact that it's in a historical site or property? That's my first question. The second one is, have you started as a community of valuators have you started to explore valuing natural assets? The conversation that we just heard about input versus the service potential, natural assets are very much looked at right now as offering the public sector entity, an opportunity to deliver services differently or to improve the safeguard of these assets. So service potential? How have you started to explore how you would measure that and how a value based on an input is relevant or not?
Yeah, thanks for the question. Coming to your first point, and I actually touch on this in my case study, but I think the fact if the property is situated within a historic building, because a modern equivalent approach is used in the DRC methodology, we're more concerned with a modern day equivalent, and typically that may take less space. It may be of a different specification, and the historic angles aren't really relevant. So I hope that answers your first point. Coming to
what would be the situation if you had, if there was essentially a requirement to, it was a kind of iconic building, and the decision, essentially you would have to put a pastiche of what was there back. Just would that change that view?
If you were valuing, for example, a local authority's town hall and it's a landmark building, I mean, just on a strict valuation approach, you'd be considering a modern day equivalent of that asset, and I suppose there wouldn't be a need to go to such a decorative condition and so on. It would. I don't think it would be correct to assume such an opulent building in a modern day equivalent.
Okay, thanks. Sorry, I interrupted, but it just seemed worthwhile exploring that a bit. So to Renee's point about natural resources.
Yes, it's not an area of expertise the valuation team as such are currently involved with at this time, but we do have a separate department that's dealing with land and natural assets, and I'm aware that their working groups meet, and I'm not so sure that valuation is the focus of their activities, but certainly they're talking about such issues. But currently it's not the core area of our own activities at this time.
Thanks, Jonathan. I mean, I think, as Ross has alluded to in previous conversations, there are sort of industry-specific approaches to, getting valuations for mineral reserves and other subsoil assets that we'll need to come back to when we move on to the next stage of the natural resources project. So if I can go to Patricia, and then I've got Abdullah, and then Nima.
Thank you, John. Thanks to interesting presentation. I would like to know if, considering the necessity to have the specific measure for public sector entity, initially the measure for public sector is expected to be entry value and entity specific value. In your view, what is the practical implication for the application of approach and the methods? And another question, do you think that it's a specific measure basis for non-specialist assets necessary for public sector? Thank you.
Yeah, just to cover your second point first of all, I believe that non-specialist assets can be covered by fair value. I don't really see a need of reinventing the wheel for those assets. To your first point, I think just a personal view on this, but I have concerns with any measure that's considered to be an entity value or entity specific? It seems unusual to me as a valuer that's more akin to a calculation of worth, and that surely we need to be considered, considering the valuation of the asset. So that's just initial personal view in terms of a potential concern with that.
Okay, thanks. So go to Abdullah and then to Nima.
Thank you, Jonathan, and thank you, Chair. I have three questions, and the first one would be a reflection on what Ajit mentioned about the specialty asset and the land. Would it be part of the asset? And for me, that does not go with the componentization concept. So if you run the depreciation of the building, you cannot consider the land as part of it. And that's one of the issues that we are currently facing as we are going through a huge real estate valuation project. Second, if you have an asset, but there is it's not an asset, wouldn't satisfy the concept of providing economical value, would you still value it, incorporate it? I have an example. For example, if you have an asset outside of the boundaries of a city and there is no clear use of it, so you wouldn't satisfy the definition of an asset in terms of an accounting standards, would you still value it? And third one, and this would encounter an example that I came across, which is we had a park, a huge park, and would you value it? Would you have a discounted value over it? Would you? Because that is one of the tricky points that we're looking for, but we're looking for an answer for it. Still, we are.
Okay, maybe turning to the third point and the valuation of a park. Could you just elaborate, provide some more details? I mean, does it generate an income as such, or is it just purely providing recreational value to the community? Is it just open grassland? Does it have development potential?
Well, that's a tricky question from your side. Well, I will tell you, it's open for the public, but part of it, a small part of it, is that I wouldn't say it provides an income, but it does, like where they rent part of it to some of the entrepreneurs, or they can run some businesses, and even the rent itself is subsidized, but they were trying to promote the full concept of the park. And for the potential of it, there is no clear potential for it, but it's like a park for the public. That's what we have in our hand now.
Okay, I mean, in my own experience valuing portfolios for local authorities and parkland, it's normally a nominal rate that's applied to it to reflect utility land values. It could be something completely different if it's a leisure park, with lots of incomes being generated all around the park, but a typical municipality park with no hope of alternative redevelopment value generally reflects low value amenity land values in my own experience. In terms of your second point, I was trying to understand the query some more and what the asset was, as to provide an opinion on whether it should be valued or not. Could you maybe elaborate on that one?
Yeah, it would be a big piece of land, and it is outside the boundaries of a city, and there is no clear use of it for the time being.
Okay, so that, I mean, in my own experience, it could be a tract of desert or something with no real development potential, no planning category as such. So if that's the case, I mean, it's presumably quite a low value asset unless there's something in the planning pipeline that would give it redevelopment value, if it's about to be allocated for a planning use. But otherwise, if it's quite insignificant land without any development potential, I would see that the value is quite negligible.
I agree with that. I brought that example because of some discussion I had with David, and we'll carry on the discussion. And even for some certain jurisdictions, they were encountering the same issue. So that's why I brought it up.
Thanks.
Okay.
Still the first one about the land, would it be part of the value of the total real estate asset?
Yeah, I mean, as part of our methodology for valuing a school, we use a DRC valuation methodology, and that is concerned with both the land element and the building element. So the land element is valued separately based on the existing use, and the building is calculated using rebuild costings and applying depreciation. But certainly the land is included as part of the overall valuation. There's maybe a separate discussion to be had if there's surplus land, which is required over and above the existing operational purpose, and maybe a case with that is that needs to be recategorized as surplus and valued separately as at fair value.
Okay, thanks. Nima.
Thank you, Ian. From Todd's question on the definition that it's UK based, and whether there is anything from the IVS on like a universal or global definition. I see the definition is the same as the definition of market value in the market value conceptual framework by the IVS. So will it be right to say that the existing use value in the UK is the same as market value as defined in the framework by the IVS?
That's not my own understanding. My understanding is that market value, our own definition of market value, accords with the IVS's. I'm not aware that the IVS's definition of market value accords with the UK definition of EUV.
Thank you. In the market value basis, an established basis of valuation in November 2021, they said that what is the market value conceptual framework? Market value is defined in IVS as estimated amount for which an asset and liability should exchange on the valuation date between a willing buyer and a willing seller in an arm's length transaction after proper marketing and where the parties had each acted knowledgeably, prudently, and without compulsion, up to just the fourth line.
Yes, that's correct. That's, as I mentioned when I was presenting, that the first part of the definition is a mirror copy of that.
I mean, it sounds like it's a similar debate to the one we've had where, you know, fair value has come in, but then there is market value as a technique underneath that. And it seems it's a similar thing that EUV has been around for quite a long while. And in a sense, actually this gets superseded as there's further experience and so on. Is that reasonable? Yeah.
Yeah.
So Renee, you're okay. Lynn, you've got a further question, and then I'll just move us on to the conclusion in terms of the presentation. Yep. Okay. Sorry, Nima, you're yeah. Okay.
Sorry, I was just going to make an observation in many respects as a reminder that the way that public sector accounting standards works in the UK is to adopt IFRS apart from where we adapt or interpret them for the public sector. So it's not that we have gone from a clean sheet of paper for a uniquely public sector valuation technique. We have gone the opposite, which is looked at IFRS 13, how does it get adapted and interpreted, which is why you end up with a market value as your sort of first base, because you're getting there from IFRS 13. So I thought that might be just worth reminding people. But Jonathan, I did have a final question, which is, I guess it's sort of, could you give us an example of where, in your experience, say market value differs and it's greater than DRC, and where it can be less than DRC in practice? So, where are the examples where are the outliers between the sort of two ways they're getting at the same valuation?
Yeah, sure. I mean, just to stress that EUV can be the same as market value, or it can be higher and lower. So maybe where situations where EUV might be higher than market value may include where a property is in an unusual location or oversized for its location, with the result that it would have a low market value, but where the cost of replacing the service potential would be significantly greater. So that may be an oversized office building in a village location in the countryside, where the market value is quite low because there are a few purchases in the market, but there is a value to the organization occupying it, and there would be a significant cost of replacing the service potential. So in that case, EUV would be higher than market value. Another instance may be where the existing buildings are old and have a limited market value, but would have a higher replacement cost to the business. So these are maybe two instances where EUV is higher than market value. In terms of the other way around, we've touched on this example earlier, but you may have a city centre site used as a school or a hospital, but where an alternative use such as a residential or shopping mall may be more lucrative and represent highest and best use. That's an obvious standout one where EUV would be lower than market value. Maybe where a property is known to be contaminated, but the continued occupation for the existing use is not inhibited or adversely affected, and there's not a duty to remedy. That's maybe another example of where EUV may be lower than market value.
Thanks. Okay. So then move us on to the final section of the presentation, Jonathan.
Yeah. So moving on to the case study. So next slide, please. So to finish off, I just thought it would be useful to briefly run through a case study of how we typically go through a evaluation of a public sector asset. So for this purpose, we're assuming a general hospital in a city centre location, and it's housed in an older listed building. So we can assume that a typical situation is that the valuation is required for inclusion in the Health Trust's annual accounts. So owing to the specialist nature of the building, there is no active market. According to the relevant public sector accounting manual, for specialised assets, current use value is appropriate, and the methodology will be a depreciated replacement cost. on a modern equivalent asset basis. So the first task for the valuer is to establish the characteristics of a modern equivalent hospital. It certainly wouldn't be in a listed building. Modern design would mean the equivalent accommodation could be provided most likely in a much smaller building. So having established the size, specification and location of a modern equivalent hospital, the valuer then has to calculate the cost of providing the facility. So you see that up on the screen now. Just to make this example more simplified, I've disregarded the time value of money and not accounted for financing costs. So we've just got a crude breakdown of the rebuild cost, including professional fees and allowing for the land cost. So finally, once the value has arrived at this stage, the next stage of the process, next slide please, is to begin the process of comparing the notional property with the actual property. This is the depreciation part of DRC. So we're allowing for physical, functional and economic obsolescence. So after factoring in depreciation to the rebuild cost, we're arriving in this case at a final DRC and value of circa 4.6 million. That's just a very brief run through of the basic high level steps in a typical valuation of a specialist asset. Happy to take any questions on that, and that's ultimately the end of the presentation. So thanks very much for your attention, and it's been useful to have a comprehensive discussion as we've gone through, but if there's anything outstanding, Steve and myself are happy to take your questions.
Thanks, Jonathan. Claudia, I think you were probably first on the draw, and then Todd.
Thank you, Jonathan, for this excellent presentation. I have a question to the last example. Where you get the land value for the existing use?
Yeah. Where do you get it? Right, good question. The best comparable evidence is looking within the hospital sector, seeing if there's any transactions in the market. Realistically, there's not likely to be many. So the next course of action is just looking for comparable evidence relating to commercial land within the area, and that may well be for other uses. And it may be considered that they're more lucrative, in which case there needs to be an exercise to compare apples with apples and make modifications to ultimately arrive at what's considered a suitable land value. It is a challenge of these types of valuations, finding that the relevant comparable evidence, given the specialism of the asset, but it's maybe a case of a wider search, looking at wider evidence available and making modifications to that evidence.
Thanks. So Todd was next, and then I think Chris, Lindy and Thomas.
Thanks. And if we can perhaps go to the next slide, because this is where I'm getting a bit confused. So on the previous slide, to get to the 53.5 million, we've included both the building and the land. And I'm seeing depreciation applied to both, and I don't understand why we would apply depreciation to the land component. When I look down to the bottom of that example, inefficient layouts, shouldn't that have been taken into account on the previous slide and coming up with the cost of the modern equivalent? I don't understand why you would separate that out. So you'd be wanting to replace the modern equivalent that makes sense to the entity. And I'm just struggling with why the cost of maintaining the building comes into the valuation of the actual asset. So a few issues there for me.
Yeah, dealing with your first point. This is typically it's quite a simplified illustrative example and applying straight line depreciation, but it's not typically separated out for land and building elements. It's considered as one and applied to the entire asset. Sorry, your second point was, could you remind me of your second point, please?
Second point was the adjustment for the inefficient layout. I would have thought when you are looking at the modern equivalent building on the first slide, which was about 45 million, I think, the 45 million, wouldn't you take that into account in coming up with the cost of a new building? So you want to actually replace it with a building that's going to be fit for the purpose.
Yeah, but in this second stage, you're comparing that modern equivalent asset with the current reality, with what's on the site, and factoring in those allowances.
Okay. So we've got Chris, then Lindy, then Thomas.
Thank you, Jan. Jonathan, mine is just a little one, an observation. The way you arrange your cost items on the first slide, for me as an accountant, I will first put the cost of land on top and then followed by the design before I put the cost of the building. But I don't know, is there any professional reason why you arrange it this way? Thank you.
The design and professional fees are typically, added to the pro rata build costs. We start with per square meter build costs and add additional fees to that element and consider the land value separately. So this is how we work. We don't add design fees to the land element. We're typically allowing for them within the building element.
Okay, thanks. Lindy.
Thank you. Probably a stupid question, but assuming the ask was to value the property at the reporting date, we've set out the methodology and the inputs, etc. If the question was impair the asset or test for impairment at the reporting date, would the same approach be applied, or would you consider additional inputs or variables in doing the valuation?
I think at the time of instruction that the valuer may not be aware of those issues and would be carrying out a market value exercise. So I'm not sure that a different approach or different inputs would be appropriate.
Okay, Lucy and then Liang.
Thank you, Chair. My question is actually for reporting purposes, for assets of valued assets in the public sector, would there be a statement in your report that valuation is subject to the prospect and viability of the continued operation and use of the asset? And if, for instance, if you have identified that an asset is a higher value for an alternative use, then are you providing information on the current value of that asset for public sector financial reporting purposes? Thank you.
Yeah, thank you. That's a very good question. So for operational properties in the UK, as we've mentioned, existing use value is the appropriate basis. So the valuation is assuming that existing use continues. Sorry, could you remind me of the second part of your question, please? Sorry, you're on mute.
Yeah, I was asking actually if, assuming it is available to you as a valuer that there is an information, a readily information that the asset is a higher value for the alternative use. Are you then providing information on the current value of the asset for public sector financial reporting purposes?
Yeah, thank you. What our guidance says is that existing use value should be provided alongside market value. But in reality and in the real world, often values aren't providing that separate market value, but it is good practice to draw light to that alternative and potentially higher market value.
Thank you.
Thanks. Liang.
Thanks, Chair. My question is, I can see the rationale of the case study. It is used a kind of replacement cost method. My question is it the most commonly used approach? And in addition to replacement cost method, will you use other approaches such as the income approach? If you use different approach to value the asset and you get a different result, how do you compare them and how to get the final valuation amount? Thank you.
Thank you, Liang. That's a good question. I think, as I mentioned earlier, the DRC is used as a evaluation method of last resort, and it is generally used in the public sector for only specialized assets such as schools, hospitals, and so on. So it's unless the school's a private school, it's not possible to use an income approach, albeit you could use some kind of profits approach or an income approach on a private school or a private hospital. In terms of other assets, yes, the income approach may be used in an operational portfolio for an office. A comparable approach may be used for land values. If you're concerned with say an office valuation, you may use an income approach. You may use a comparable approach and then a DRC approach and consider the outcomes from all three methods. But it's more likely that an income approach or a comparable approach is much more relevant, that there's no need to be using a depreciated replacement cost for a non-specialized asset.
If I can just jump in, I think the other question she had was on the reconciliation of values when you use more than one approach or method.
Yes.
If you're using more than one approach in terms of evaluation to value an asset, if generally the values from both approaches is similar, weighting them 50-50 is reasonable. I will say I can say it's definitely bad practice if both approaches give you differences, significantly different value, let's say 100 versus 400, and you're averaging the two. That's probably not good practice to consider. And that's when the valuer has to consider in that particular case, which is the most appropriate approach. So just by averaging the two doesn't always make sense, especially if the values are different. So that he needs to go back or she needs to go back and see, what is the most appropriate approach. In some cases, the discounted cash flow method might be the most appropriate, and sometimes the market comparable method might be the most appropriate.
Thank you.
Okay, thank you.
Thanks. So I think that's been a very helpful session in terms of being able to understand some of the challenges that the valuers face in practice. I think probably this is the point at which we should start to move into the papers that staff have presented, and then obviously draw in Steve and Jonathan as we move through those. Probably it's worth reminding ourselves that, some of the sort of drivers as to why we were looking at a current value, but for specialized assets in the first place, one of them being the ability to use information not only for financial reporting purposes, but also for statistical reporting purposes. And there you cannot use historical cost. It's going to have to be a current value. So that was one of the drivers here. I think it's also probably as a reference for our future debates, and picking up on what Steve said. Given that if we move forward with a current value basis, it will be important that it can be operationalized in practice. It certainly seems that there is some scope here for the debate that we have, and where we finally end up to influence what might end up in the sort of Rick's guidance, because you'd need to have that bridge. And so there obviously is some space here to reflect the debates and the outcome of the debates from the board in terms of perspective and overall approach. Clearly, anything that we arrive at there'd need to be some more detailed discussion subsequently in terms of, how you might, the precise components might come together and so on. And that might well be a piece of work where if we'd set the overall approach, then there was scope for sort of further task force work in terms of precisely, how you operationalize that in practice. And I think also just going back to, by way of context, just going back to the statistical reporting context, that's something where the international statistical standards are being updated at the moment, and certainly we've had discussions with them about how the scope for refining their guidance in terms of, again, the interoperability of work. So I think it seems to me, if you put those together, that actually the discussions we're going to have on perspective here are really important in terms of feeding into both the discussions, the further work that might be done working with the valuers, but also linking that into the ability to use for statistical reporting purposes. So I think that makes the discussion we're about to have very important, because that should solidify some of those issues. So perhaps at that stage, sort of Dave, if I might hand over to you to introduce the papers, and then we'll start to work our way through some of the issues that you've raised in the papers.
So I'll let Tashreeq go through the papers individually, but maybe just a high-level overview of how it worked this quarter, and some comments that we've received from board members before we entered this session. One, with this quarter, we really focused on COV. Obviously, we really focused on SMC 5 and 6, I believe. And especially early in the quarter, we spent a lot of time returning to the core concepts that were proposed in ED 77. So on reflection, on looking at these papers again and some of the comments we received from board members, they are very conceptual in nature. We did want to cement some of the concepts, or make sure the board agreed with the direction that we were proposing to go. As Ian mentioned off the top, we didn't want to move to a definition at this point. We really wanted to stay in the concepts and build on those concepts. So with that, I will let Tashreeq take us through the first agenda item that really looks at a summary of the responses so that you can get a flavor of what we heard from respondents to ED 77 on current operational value.
Thanks, Dev. Morning, everyone. Can we go to the next slide, please? Okay. So with regards to agenda item 4.2.1, like Dave mentioned, staff spent this quarter evaluating constituency responses.
Could you speak slightly closer to the microphone? It's quite hard to hear you.
Sure. Okay, so with regards to agenda item 4.2.1, staff spent this quarter evaluating constituency responses to SMCs 5 and 6 of ED 77. These SMCs focused on the current value measurement basis developed by the IPSASB, namely the COV basis. And the COV basis was essentially developed in response to constituents' concerns that the fair value measurement basis is difficult and inappropriate to apply, given that the concepts of the highest and best use and maximizing market participant input data are both not applicable in the public sector. In analyzing the responses to SMCs 5 and 6, staff noted that approximately 2/3 of respondents supported the direction and objective of the COV basis. However, constituents' responses were quite broad, and they ranged from the vagueness of the definition of COV to a request to provide additional guidance and examples that allow the definition to be operationalized. Now, staff categorized the comments in SMCs 5 and 6 into 6 overarching themes, which are displayed on the slide, which have been further analyzed throughout this agenda item. The decisions reached in this entire agenda item will be used to develop the COV basis in the next quarter. At this point, I'll hand over to Ian for any initial comments, questions from the board, specifically on the responses received from constituents on SMCs 5 and 6.
Thank you, Tashreeq. And obviously, you've done the further analysis in paper 4.2.1 against those headings at the bottom. Todd.
Thanks, Ian. Reflecting on the themes coming through from the comments on SMCs 5 and 6, I would say it's quite fair to say that hardly anyone is actually supporting getting rid of some other measurement basis and only having fair value. I think even those that might have said they disagree with COV were offering something other than fair value as defined by the IASB without any adjustment. So that suggests to me that we have something that has to be dealt with here. So it's helpful to understand, you know, there's certain people that agree partially or disagree, but the overwhelming, for me, the overwhelming takeaway is there's something that we have to address here. And I think the fact that, you know, we got, you know, a reasonable number in the sort of partially agree and disagree, we have to do something to what was actually exposed to address a lot of the issues that have come through. But I just make that observation at this point.
Thank you, Todd. I think that's helpful to have that perspective at this stage, because clearly there were a lot of comments, even amongst those who were classified as disagreed. Actually, when you dug beneath the fact, they were actually raising a lot of the similar concerns to those who partially agreed, or even those who agreed. So I think, you know, one of the key things that we do need to confirm, and I think staff alluded to this earlier, is that, you know, what we agreed last time round was that fair value should be included on the basis of fair value as defined and expressed in IFRS 13, and that what we have here is something different, which is to your point. I'll bring Thomas in a moment, because I think this came originally from the CAG discussion, that if you mean fair value, then it should be the same as fair value as in IFRS 13. And that's probably the first decision that we need to make, to just say, right, okay, as you say, Todd, we do have something separate here, whatever that separate thing actually is, and that'll be where we move on to. Thomas, I'll bring you in without sort of putting words into your mouth anymore at this stage.
No, it's all fine. I just wanted to kind of at that point flag that it was exactly what the CAG said in December, not this time, but already in December when we discussed about should the board continue with the development of a COV in general. There was, I think, the overwhelming perspective that there is a need to develop a basis which is different from fair value as understood by IFRS 13. There was not kind of a unanimous view on what that should be, but it must be something different from fair value as IFRS 13. So just to kind of support totally what Todd said was kind of discussed in the CAG as well.
Thank you, Thomas. Dave, you wanted to come in?
I guess if we're supporting Todd, I'll support Todd as well. I just thought it was a good way to frame it, Todd. And I think that's a good way to look at this paper, that you're right, there was an issue identified that the IPSASB needs to address. There's different ways to do it. And the way I would look at this package of papers is going back to first concepts, and we wanted to get the board agreeing on what those first concepts are. So I think that's a good way of looking at the package of papers today.
Thank you, Dave. So I think probably what comes out of this is we just need to be absolutely clear. This is the fork in the road in terms of we've already decided that we will bring in fair value as defined in IFRS 13. And as Todd has put it, you know, we have been dealing with something else that isn't fair value as in IFRS 13. And therefore, I think it's quite important that we actually as a board do confirm that we are going to move forward with something else, and as Dave has put it, you know, we'll start to move into what might that something else be. At the moment, we've labelled it COV, but whatever it turns out as in the end. So can I just confirm that people are happy that we are developing guidance on a separate basis at this stage? Which is not fair value as we've already agreed to bring into the framework. Lynn?
I think it would be helpful to clarify if we are just referring to assets held for their operational capacity in making that decision, because previously we have used fair value in assets held for their financial capacity. So I think we need to be very clear on that.
Thanks, Lynn. I mean, I think that's, you know, generally agreed. I see nods on that. And certainly that would be consistent with what we agreed in approving IPSAS 44, where you can access that market, then that's the appropriate basis. Okay, so I think we're content with that. So we are developing that alternative basis. So I think that is probably the decision that we need out of paper 4.2.1. Am I right, Dave?
4.2.1 was more of an information or just a background paper. It's no decision necessary. To Tashreeq, unless I'm wrong, but
I think that is a clear underpinning in moving forward that we are developing something, and it was implied by our previous discussions, but I think we should record that as a decision that we are developing something different, whatever that something different is, because that is the necessary basis to move us into the next stages of the discussion. And I think it's helpful in the staff paper that you've identified those as the key areas of disagreement, because then that allows us to move forward and discuss those as we move through the subsequent papers. Okay, so then I think we can move on to the next paper.
Thanks, Chair. So with regards to agenda item 4.2.2, given the wide range of constituents' responses, staff considered it prudent this quarter to revisit the core principles of COB. taking into account the additional views and additional information provided by constituents. Now, a fundamental concern that constituents noted is that the COV basis does not reflect the value of the assets in the way that the public sector uses them. In other words, to deliver direct services to the public or to provide a community benefit or both. Now, given that this comment was raised by a few constituents, staff took essentially a big step back this quarter and reevaluated the lens through which a public sector asset is measured. In other words, in order to measure the asset, staff reconsidered whether the service performed by the asset should be valued or whether the physical items that comprise the asset should be valued. And staff identified three lenses, which is what is being displayed on screen. Staff identified three lenses through which the measurement of public sector assets could be viewed. So firstly, we have the outcomes lens. This is the broadest measurement approach available. And this lens values the asset based on the broader economic, social, and environmental benefits that the asset provides. Then we have the outputs lens, and this lens values the asset based on the outputs that the asset is held to provide. So in other words, the services that the asset delivers to the public. Lastly, we have the inputs lens, which values the asset based on the inputs that comprise the physical asset. Now, it is important to note that both the outcomes and the outputs lenses are particularly relevant in the public sector, where entities generally hold assets to deliver a service or to provide a benefit or both. However, an outcomes and an outputs-based approach would result in the asset recognition criteria not being satisfied, as there's no well-established method to value the service or the benefits provided by an asset in a relevant and reliable way. Staff noted that where the outputs and the outcomes-based approaches present challenges, the inputs-based approach actually presents solutions. So as an inputs-based approach is firstly consistent with underlying IPSAS principles, it is a well-established methodology in the valuation community, and it is consistent with the original principles proposed in ED 77. Therefore, based on the decision reached in this agenda item, selecting the relevant measurement lens and emphasizing this lens in the non-authoritative guidance of the standard will allow staff to make the core principles of the basis as clear as possible. Consequently, the relevant measurement lens selected by the board will assist staff in flushing out any inconsistencies and ambiguities in the standard that do not align with the core principles in the measurement basis. Next slide, please. Therefore, staff recommends that the board retain the proposal in ED 77 that the public sector measurement basis is based on the value of the underlying physical item. I'll hand over to Ian for any comments or questions from the board, specifically on the relevant measurement lens to be used in the COV basis. Thanks.
Thank you, Tashreeq. So at this point in time, as this was an issue considered by the CAG in their discussion on Monday, I'd like to just get Thomas's feedback from the CAG discussion, and then I'd also just like to check that whether there's anything that either Jonathan or Steve wanted to add before I open it up for board members' discussions. So Thomas, to you.
Yeah, thanks. Indeed, the first issue in the measurement section was whether the CAG members agreed that the IPSASB should continue developing COV as a measurement basis based on the input approach. And I think I can confirm that kind of members agreed that the inputs approach was the most practical approach to apply when measuring public sector assets. But they advised clarifying the concepts and terminology around that to ensure stakeholders better understand COV on the basis of inputs. There was some kind of discussion around the terminology of what is an input and things like that. A second argument in favor of the input approach was the reliability of data used for the input approach compared to outputs or even outcomes, which are hard to be measured reliably. Some members highlighted using an outputs or outcomes approach results in asset valuation, including items which are not directly attributable to the assets, i.e. the value of the education provided by a school requires measuring of outputs of multiple assets. And I have to say this problem, however, was identified for the input approach as well. Members noted that in most cases, services are not provided by a single asset, but through the collective use of multiple assets. And there needs to be a lead over how to break down this collective use to the contribution of a single asset, hence the service potential of these single assets based on the service potential. So it was recommended to clarify that point.
Thanks, Thomas. So just take any comments from either Steve or Jonathan at this stage. And then I think before we go for a round of members' comments, I think we'll take our second break at that point in time. Steve or Jonathan, anything you wanted to add to what was in the staff paper?
John, I don't know if you have any comments, but I have nothing to add.
Jonathan?
I've got nothing from my side, thank you.
Okay, thanks. So I think at this point in time, we take the second break. And I think if we can come back at 10 to the hour, then we can take a round of member comments. Thank you. Okay, so before we get into the member comments, Dave, you just asked from a staff point of view if you can make just a couple of clarifications.
So prior to the meeting, we received a few comments on this paper that I thought I could help clarify right now. So two I want to make. One is on what inputs means. We weren't trying to get to an exit or entry view here. What we're really trying to focus on inputs is the physical asset itself. So the school, the building, that's what we're focusing on, not the educational services or, as Tashreeq said, the broader impact to GDP of having a school. It really is the building, but we're not focusing on entry or exit. The second point is, and this goes back to an earlier comment I made, assuming you agree with this paper, what's the impact of agreeing with this paper? Because it's a long paper with a lot of conceptual discussion. And really this is just highlighting the work that staff put into this, and that we really went down a number of rabbit holes on this one and spent a lot of time at a conceptual level. Assuming the IPSASB agrees, I think it turns into some basis for conclusions. We're not proposing changes to any authoritative text, but just wanted to clarify that because I know it's a longer paper.
Thanks, Dave. And obviously it's making sure that we respond to, or that we've actually been seen to consider the range of comments that we've received from stakeholders. And I think that's been an important exercise in doing that. So if obviously staff is recommending that we go down that broader, as it's described, input based approach. I just wanted to check whether, and that's consistent with the, if you like, the tenor of the CAG discussions, particularly the issue over not meeting other outcomes, not meeting recognition criteria and practical problems and so on. Does any member disagree with that recommendation then in terms of proceeding on that inputs basis? Mary.
Thank you. From my point of view, I understand the input approach is so practical, and the diagram is so clearly described. And however, in public sector, there is some kind of problem between the input and linkage between the input and output. And so the RPG3, based on RPG3, it is clearly input are the resource used by entity to provide the output. It is consistent with this diagram. And however, in reality, in the government public sector, the input is decided by the very complex elements and factors, such like the political decisions, or so the input is based and decided based on the public demand and needs. And however, it is not practical in the real situation. And so the inputs in the private sector, inputs and the linkage between the inputs and output is so close. And because the performance criteria is profit, it is a homogeneous criteria. So the private sector always watch the linkage between the relation between the input and outputs. And so the input approach is so appropriate. And however, the public sector is different characteristics. And so it is so difficult that based on the conceptual framework, entry value is defined. It reflects the cost of purchase, and the cost of purchase and the service delivered is quite different. And so I have a question about the approach. Thank you.
Thank you. Dave, perhaps I can go back to you on that. I think it's sort of, you know, just to kind of elaborate perhaps on those opening comments you made.
So, Mari, maybe to give a little more background, what we were trying to explore with this paper was comments that we received from stakeholders agreeing with the IPSASB that assets held for their service capacity or service delivery, that was the really unique aspect of public sector assets. So we were exploring different ways to measure the service delivery aspect of those assets. And like Tashreeq said, we went through outcomes and outputs, and at a conceptual level, it was attractive to us, but as we dug deeper and deeper, there was no consistent way to measure those in practice. We didn't think they would be relevant or reliable measurements, and that would impact recognition criteria in order to even recognize the asset. So that's why we backed away from those. I take your point that, I think this is your point, that in the public sector, that's why those assets are held, to provide services, but ultimately we decided that measuring the inputs or the building itself was an appropriate proxy to show the value of the services that those assets are providing.
Okay. Thank you. I understand. And however, the current operational values definition is so vague. I'm so sorry, the wording. And so maybe the outputs are the service provided. So to achieve the objectives, so how to define definitely to the value, operational value, it's the so point of issue, I think. Thank you.
So I think, you know, I see where you're coming from now, Mari, and I think, you know, actually you've just underlined the reason why staff is saying actually what we need to do is get our philosophy right. And then you're quite correct that actually we will need to revisit the definition, and that's why they sort of said, well, let's talk about the principles at this meeting, and then we'll come back and discuss the definition once we've actually tied those principles down, so that we can deal with exactly the issue that you've actually raised. So I think that's really helpful to have had those comments now, because staff can factor those into proposals that they bring either at the check-in meeting in July or into September. So thanks for that. So if I can go to Lindy, and then Patricia, Lucy, and Claudia.
Thank you very much. So I do agree with the proposal. And I guess what you're also saying, Dave, is that this is kind of just the foundation, and you know, we would build from there, because I was conscious of what the CAG was saying earlier this week around the wording, like inputs, and the confusion that it could lead to. So I suppose we're using inputs for now, but as we evolve and determine what this all means, it might be defined or redefined, because I think that's maybe some of the challenges that some members have, or CAG members also had, in understanding this. So, and also looking at it, you know, we kind of got to the same point that you're looking at the physical item, or more the rights to the service potentially embodied in the item. And that's what you're focusing on, because it is a modern equivalent as well. So it is, you know, those rights and the service potential embodied in those in that asset. But I suppose we could then comes other questions around, well, when you're looking at a modern, but maybe I should wait for that for a later stage. But
yeah, I think if you can, I think one of the things that came out very clearly was that confusion over terms and how we're using them. And I think we're going to need to focus very clearly, if you like, we need to get our ideas sorted, and then make sure that the terminology is absolutely clear for people and how that's used. And yeah, you're right, we can get into the more detailed issues coming up. So I've got Patricia, then Lucy, then Claudia, then Renee.
Thank you. My question is similar to Lind. I agree with the input lens, but I think that there are assets held for operational capacity that have no physical substance. And then I think maybe the way to solve it connect the approach with the new definition of assets in the conceptual framework. In the end of the day, the end measure the rights to service potential. It's my suggestion. Thank you.
Thanks, Patricia. I think that's helpful. We do need to think about that, and I think that's consistent with some of the other comments, the other conversations I've had offline. That it will be one of the things that we need to do. So if I can go to Lucy, then Claudia, then Renee.
Thank you, Chair. Actually, I also concur in the staff's recommendation to use the underlying as inputs, but similar to what Patricia had said, I let us reconsider whether we are only limiting it to the physical item, because there could be other non-physical items or intangible items that can be used as basis for measuring assets in the public sector. Now, and consistent with what Dave had explained earlier, I also suggest that a BC, the inclusion of a BC to support the personalization on the retention of the proposal in ED 77. And the BC shall capsulize the analysis put forward by the staff in paragraphs 10 to 24 of the agenda paper. And probably aside from the staff analysis, we can also include in the BC that the explanation that the outcomes and outputs of services delivered could not be attributed only to or solely to the public sector assets used in delivering the services, but also to other factors such as contributions of the private sector and the citizen beneficiaries in attaining the outcomes and outputs of services delivered, and that it is extremely challenging, if not impossible, to disaggregate the value of the outcomes or outputs attributed to the use of the public sector assets for the purpose of measuring the assets in the public sector. Thank you.
Thanks, Lucy. So if I can go to Claudia, then Renee, and then Leanne.
Thank you. I agree with the recommendation of the staff, but I think the explanation regarding the outputs in the documents might be misleading. In paragraph 19, we said as an example of measuring, focusing on the assets output would, and then there's one example mentioned, the amount individuals pay or would pay to receive the education. And in paragraph 20, we say, however, an outputs-based measurement is inconsistent with how all other non-financial assets are measured in IPSAS financial statements. I remember one of the decisions in the board was that we allowed the income approach for current value, not only for the fair value, even for the current operational value, which is totally conflicting with the view what we're saying about the outputs here. So maybe I misunderstood it, but it should be clearly communicated then when we're going further on what we what we mean by then the income approach instead of output.
Yeah, thanks, Claudia. I think that certainly is a takeaway that the staff will need to draft the basis for conclusions consistently with where we end up on our other decisions. Obviously we've got a paper on income approach coming up later and so on, but thank you for drawing our attention to that. Renee and then Leanne.
Thank you, Chair. So I also agree with the proposal. I pause on limiting it to underlying physical items, and maybe that's not what we meant to do. In many cases, the underlying physical item will be the input or the basis for the input. But again, I'm thinking about natural resources as my test. A replacement cost for a natural resource may be to look at the cost of providing the same service using an engineered item as opposed to the natural resource. So this would be an example that for me would test wanting to be broader than just referring to the underlying physical item. So that's something that's kind of a detail we can deal with later, I suppose.
Thanks, Renee. And I think that all of this is consistent with the comments already made, that obviously it's easier to think in terms of tangible items and plant and equipment, but actually this does need to go broader in terms of thinking about rights and so on. So again, that underlines we need to get the explanation right. And I think that was actually one of the important takeaways from the CAG discussion, actually, that communication is going to be really important. Liang.
Thanks, Chair. Actually, I'm quite struggling about the input. It is said the valuation method is based on the input, because I think many items in public sector, maybe it is hard to have the physical item, as Renee just said, natural resources. And I'm also thinking about the heritage asset. Actually, I think for the heritage asset, the most valuable item, maybe not the physical one, but something inside the assets, the history, and something like that. So I think if we only say it is a physical item, maybe cannot reflect all the value or all the factors we should consider about the valuation. Another thing I'm thinking about is if we say the valuation is based on the input method, does it imply that only replace cost method is allowed? Because if we say income approach, actually it looks like the income approach we based on the income, the discounted cash flow. Is it a kind of output? So I'm quite struggling about this. Thank you.
Thank you. Dave, I don't know whether you want to just comment on that.
Well, reflecting on a few comments, I think the IPSASB discussed this in 2020, and the way it was discussed might be an easier way to phrase it in the basis for conclusions. You discussed valuing the service versus the underlying item. So maybe kind of going to this three-circle approach, I think, at least in my view, was good to have a discussion here, but I think might be too difficult or not useful to have in a basis for conclusion discussion. So I think just focusing on the previous IPSASB decision is a more clear way to communicate this point. I think that addresses points raised by Renee and I think Claudia on what was actually being valued, and maybe that helps with Liang as well.
Thanks. I mean, I think, I'll talk over Adrian, but then I think the sense I'm getting is albeit it's imperfectly described, there is support for inputs because of all the challenges that we've noted in terms of anything more broad. There will be a need to communicate very clearly what we actually mean. And as you say, it may well be easier to go back to the earlier description of the decision in communicating what we finally decide. But I think the points raised by members have been very helpful in terms of highlighting the challenges that we face in terms of communicating the overall approach that we're taking. Adrienne, final comment, and then I'm going to move us on.
Well, I do support the input lens, but I was thinking of other discussions we're currently having, namely on natural resources. And I was thinking of the water that is contained in a reservoir, in a dam, that is only held for being processed to produce electricity. And I can't figure the application of the input model to evaluating this water, provided that it's measurable, recognizable as an asset. So,
I mean, I think we've got a lot of interlocking debates at the moment, and for example, heritage we're going to come to tomorrow. Natural resources, we're only at CP stage, so I think we just need to deal with what we can at the moment. And going back to natural resources, water is very much on the boundary at the moment in terms of it might be in certain circumstances. For example, if you provide a bulk water supply from a reservoir and that's all you do, is very different to I've got water in a dam and I'm going to put it into pipes to serve a population and industry and all of those kinds of things. So I think we need to be careful to deal with the issues that we can deal with at this stage. And let's just build what we need then at this stage, and we'll end up with something that will be a broad approach that can then be applied in particular circumstances. But we need to get the philosophy right, is what we're really trying to do at the moment. Okay, so I think broadly what the board is saying is we support what is described here as the inputs approach. We recognise there are significant communication problems, consistency problems with decisions that we'll take later. So I think, all of those are important points that board members have highlighted. Certainly, we will need to be consistent in the approach in terms of thinking about if we go if the recommendation to move to a rights-based approach to defining assets, that will have an impact. But we just need to be consistent throughout in terms of communication and being precise. Okay. So with that, let's move on to the next paper, 4.2.3. Now, in terms of 4.2.3, I'm going to suggest that the first part of that, we've already taken the decision that fair value will be fair value as defined in IFRS 13. So we're not going to public sectorize it. So I'd like to focus on the second of the recommendations only in that paper, please.
Thanks, Chair. Next slide, please. Okay, so with regards to the alternative of replacing the COV proposals with the replacement cost concept, in developing the ED, the IPSASB agreed that replacement cost was a measurement technique that could be used to estimate a measurement basis. And the IPSASB reached this view after respondents to the measurement CP rejected the initial view that replacement cost was a measurement basis. So as the board previously considered the option to use replacement cost as a measurement basis and has not chosen to go down this route, staff recommends that the board move forward with the COB proposals in ED 77. I will hand over to Ian for any comments on that recommendation.
Okay, thanks. So we're on the second part of the paper now, and take any comments on that retaining DRC as a technique. Todd.
Thanks, Ian. And as I sort of said earlier, I think it's really important that we do address the public sector issue. In addressing the public sector issue, in my mind, a depreciated replacement cost basis is going to be probably the technique that is used predominantly in what we come up with. And I'm not convinced that that alone should be what we look to in the public sector. But I don't like the way that COV is currently defined. I don't think it's clear enough. So long as in agreeing to take COV forward, what we mean is take forward a public sector measurement basis, however we describe that, then I'm comfortable. But I think we have to listen to some of the feedback we got about just the lack of clarity in what we're trying to do here. And I do, and it will be no surprise, I do wonder whether the way that I express things in the alternative view around what we're trying to achieve out of a public sector measure is essentially what it's going to cost that public entity to be able to replace the remaining service potential embodied in an asset might be a clearer way of thinking about it. And that would lend itself to depreciated replacement cost as a technique, but it could also lend itself to a market value as a technique, because some of the assets that are used in the public sector, you could probably go out and buy them in the market. So as I say, agree to take the concept forward so long as it's not agreeing to exactly the way that it's described and explained.
Thanks, Todd. I think that's a very helpful explanation. And certainly I think that's the understanding that the definition and indeed the term still needs is a decision that we will take subsequently. But I think that's a good way of looking at it, that it may well be commonly used, but not 100%, so there isn't a correspondence. So I think that's helpful. Adrian, you're not still in. Camira, you want, sorry, Todd, you just wanted to come back briefly before I go to Camira? Okay, Camira, to you.
Thank you, Chair. I just wanted for clarity, because I know that there are several weaknesses that the respondents identified. I agree with the decision that we have already made, okay, leave the fair value as it is and not try and continue with the idea of developing a public sector measurement base. But I think it's important to also present some analysis, because some of the respondents identify that the current guidance in fair value also applies, for instance, for the highest and best use. They say, well, in that case, you can assume that the highest and best use is the current use of that the entity gives to the asset. So we should, if we already decide that we will move forward the public sector measurement base, we should also be able to distinguish why we cannot use fair value, so justify it better, because as of now we are not doing it as it is, or at least not addressing these specific weaknesses that were raised in the comment letters. Also the distinction between current operational value and value in use and so on. So I agree with the recommendation that we move forward on this, but also taking into account the weaknesses that were identified, and also what was with the support that the alternative view received and all that, because that analysis, I think it's still missing. Thanks.
Thanks, Camira. Dave, you were sort of hovering, and I know Tashri, I mean, I think there is no doubt that we have to explain the difference between the public sector basis that we're talking about and fair value. I think you're right, that came through from constituents' comments that we hadn't explained that and we hadn't been clear enough about it. And particularly, is it just highest and best use? Are there other factors? And I think we do need to pay clear attention to that explanation. So in a sense, actually, what we're doing now is working our way through what do we think the broad shape of this thing should be. And then we will need to make sure that the explanation that we give is absolutely crystal clear. And members have also picked up on inconsistencies at the moment through the previous discussions. So Tashreeq, to you.
Thanks, Ian. Just to respond to Camira's and Todd's points. So essentially, the next paper is it's kind of the crux of this, because what we really want to do is lock in the key principles of a public sector measurement basis, and then that will essentially develop the analysis for why highest and best use is not applicable, and what exactly the key differences are between the private sector and the public sector. So that analysis is coming through in the next paper. Just wanted to clear that up.
Thanks, Tashreeq. That's probably quite a neat segue, unless anybody else has any comments in terms of agreeing with the staff recommendation. Okay, so with that, I think we move into item 4.2.4, and this is where indeed we start to move into getting some shape to the concepts, and probably particularly the summary that is provided in the table in paragraph 12 is very helpful. And I might propose that we actually sort of move through each of those in turn in terms of the different attributes that are there, because it picks up both the accounting argument and the valuation argument. Dave.
So Tashreeq, do you want to take us through item by item, and we'll start with existing asset and then have a board discussion?
Yeah, if we can do it that way, I think that's helpful, because then we're kind of, we can identify where we have agreement on the sort of overall characteristic, or where there's some, disagreement, or we're uncomfortable with anything. So yeah, if you can walk us through each of those in turn, that would be really helpful.
Okay, perfect. Thanks, Chair. So at a very high level, ED 77 proposed 3 core principles that are necessary to measure an asset health for its operational capacity. And if you consider each principle, so firstly, with regards to an existing asset, so it's important to remember that COV is an asset-specific measurement basis, and the focus of the measurement basis is the existing asset, how to meet the entity's service delivery objectives. So essentially, we are considering an asset that is presently available or in operation, rather than the acquisition, development, or construction of an asset that is planned for the future. With regards to the existing use principle, so the existing use principle requires the entity to...
Sorry, Tashreeq, can we just pause before we get into existing use? I want to go, segment by segment here in terms of, so, I think this is where the table in 12 is useful, because it just goes through. So if we can just pause and get any comments on existing asset. I just want to check we've got agreement as we move through. So Mike, you wanted to come in on existing asset.
Yeah, thank you, Ian. Just a little comment on that box in paragraph 12 on existing asset, relating to the second question, because it's a little bit not intuitive if the core principle existing asset is explained via existing use value, which is another principle. So maybe it's worth to keep that in mind. Thank you.
Thank you. I'll take Todd and then go back to the Secretariat.
Thanks, Ian. I agree. At a high level, it is the existing asset that we're looking to value. You'll get into a layer of detail below that, modern equivalent, and there may be surplus capacity embodied in the asset, and you have to start to think. So there's a number of things that you need to think about underneath this high-level principle, but I absolutely agree that, if we're valuing this building, we're not imagining it being 10 miles over there sort of thing. We are valuing the asset, and then whatever we agree are the appropriate things to think about, modern equivalent, etc.
Thanks, Todd. And I think, your point about a layer underneath that is probably consistent with the point that Mike was making as well. Anything else to add, Dave or Tashreeq? I'm not seeing any other flags raised, so I think we can move on to the next stage of the argument, which is existing use.
Thanks, Chair. Just to respond to the last comment. So it's exactly that. The core principles that we're looking at in this paper is essentially the starting point, and any other bespoke scenarios and alternatives that forms the additional layer. So just to clarify that. If we move on to the existing use principle, so the existing use principle requires the entity to measure the asset by disregarding any potential alternative uses and any other characteristics of the asset that could maximize its market value. And with regards to whether this principle is consistent with the approach taken by the valuation community, as presented by Jonathan earlier, this filters through in the existing use value definition. Thanks, Chair.
Okay, Todd, I can see you hovering. Go on.
If we mean existing use, as it was set out in the earlier paper around existing use value, then I disagree with this as a principle to take forward. In my mind, when we say existing use, if we are valuing a specific school that has been built for 600 students, then the existing use is a school. We're not going to value it as if it's used as an office block or, for administrative purposes or whatever. It's for the school purpose. So I just want to draw the distinction. If we are talking about the existing use value as was described earlier, I disagree. If it's just what I described in terms of the school example, then I agree with this as a principle.
So perhaps on that, because clearly I think the definition of EUV as presented at the moment, members had problems with earlier. I just wonder whether I could go to either Jonathan or Steve at this stage and just to sort of comment on the way in which Todd's just expressed that. Because clearly you have a problem with the definition, but not the principle itself, if I can describe it that way, if that's right, without putting words into your mouth. Because I think some of this is actually we need to get the shape and the concepts right, and then there's a sort of layer of operationalization or layers of operationalization that sit underneath this. So Jonathan or Steve, any sort of immediate reactions to the point that the distinction that Todd was drawing there?
Yeah, thank you, Chair. I'd agree with Todd's point that the principle applies of nailing the existing use, but a definition to come out in the subsequent detail. But I'm in accordance that existing use is a core principle of any public sector measurement basis.
Dave?
Just for clarity, that was staff's view. The way Todd interpreted it was the way staff was trying to communicate it.
Okay, thanks. That's helpful. I mean, clearly it's tricky, and words are always problematic in terms of people can kind of agree on a concept, but putting them down on paper is always difficult. So what I'll do, I'm going to take member comments first, and then I'll go to Thomas for the CAG view. So in terms of hands up at the moment, Mike was first, and then I've got Ajith and Scott.
Yeah, thank you. Just a minor comment on the second box within the existing use row. The school example, the last sentence, or let's say the outcome, that is not, let's say, crystal clear, because it should be considered to be redrafted a little bit, that it's the end of the sentence and it should be valued accordingly. There, at that point, we should make clear that it should be valued based on its full capacity to make it clear what the outcome of this is. Thank you.
Thanks. I'd like us to have a discussion about the surplus capacity point separately if we can, but we note that point. Thanks, Mike. Ajith and then Scott.
Yeah, thanks, Ian. Yeah, one of the things I was considering was I think the existing use is quite appropriate in relation to specialized assets. But sometimes some of the assets which are not specialized the existing use may not be. We don't need to restrict to existing use, because there is a basis on which it can be valued more easily using the market value. Because for instance, if you take a land on which the school is built, I think should be valued based on the land value in that area. So which is the market value of that land. If the land is in a very expensive area, then I think that land value should still come into the balance sheet, because that is the value of that land, and that value of that land is useful even for the public sector school, because the public sector decided that a school should be there in that particular place, and it's expensive if you want to buy another land in order to put a school in that expensive area. We still have to buy that land at that price. So therefore, I think there's items that can be bought from outside, which can be used for other purposes, and therefore, or we need to buy it for other purposes, more reflect the market price of the land. So I think in those cases, market price is more appropriate. Thank you.
Thanks, Ajith. What I'd like to do is come back to that issue, because I think it relates into the location issue, but it also relates into, I think, the point that Lynn made earlier in terms of specialised, non-specialised. So if we can kind of come back to that point later on that, when we get into the discussion on location, I think that would be helpful. So if I can go to Scott next, and then in terms of member comments, I've got Hervé, Adrienne, and then I'll go to Thomas. So Scott.
Thank you, Ian. Yeah, I raised my hand to support Todd in his comment about existing use, and I know you didn't want to go to surplus capacity yet, but I think if you go that definition, it makes that answer easier. Because you use it as it exists, which includes its surplus capacity. So I think it helps that answer the way Todd has defined it. Thank you.
Okay, thanks. We'll go into surplus capacity any moment now, but I just want to kind of take the round of comments. But I think we note your comment going into that. I suspect Todd doesn't agree with that, but we'll come to that in a minute. So Thomas, if I can take your comment next.
Yeah, the second issue the CAG discussed was actually whether the CAG members agree to valuing the asset based on how it is currently used, in deviation from the highest and best use assumption of fair value. And I think in general, I can say that it was supported. On the other side, there was kind of some discussion around the potential kind of public sector specific interpretation of highest and best use. So just to consider whether the highest and best use assumption could be understood in a public sector specific context by limiting the potential uses of an asset to different ways of service provision. So in other words, like the school example, could it be used for different ways of services being provided? So I think that's in a nutshell just an additional thought.
Okay, thanks. And I think we've got the this challenge around valuing, what's there as a school rather than, some hypothetical future market where you might be able to build housing on it or whatever. And those were the sorts of issues we also worked through in the context of IPSASB 44, which was actually, it can take a very long time to be able to be at the point where you can actually use it for something else, which is where you can actually access fair value. So, okay, so I've got Renee. Ajith, you're not still in at this point, or no? Okay.
No, I've completed. Thank you.
Okay, Renee.
Thank you, Chair. I've been reflecting on a conversation this morning with Jonathan when I asked a question, and he brought up the concept of modern day use, and it was very helpful for me to understand that this is one of the angle that's taken by the valuators. And I'm trying to fit it in one of the three principles. So is it existing use? Is it existing asset? I'm not too sure, but I wouldn't want us to lose that concept. I don't know where it fits. Maybe it's later down. It's down, but I just wanted to share my reflection with the board.
Okay, thanks, Renee. Yeah, David, do you want to just clarify on that? I think you were
no, I mean, the principle is that you're valuing the asset that you've got. You're valuing the asset in its current use. The approaches that the valuers might take will depend on the circumstances. And so your point, Renee, is actually the sort of the layer down, okay?
Okay, so Scott, perhaps you, as we move into surplus capacity, perhaps you might want to just remake your point, and then I'll allow Todd to come in, because I know he was sort of he was hovering when you made your point.
Yeah, be glad to. I personally have a hard time with valuing surplus capacity. Because I may have, what is surplus capacity? Because I have three rooms open I'm not using, is that surplus capacity? The fact that we just went through a pandemic and my building used to have 3,500 people, it had 150 people in it. Is that surplus capacity? I don't really know. So I thought the reason I like Todd's point, and I still do, is it's existing use as you choose to use it. And you continue to use it with that excess capacity in it as it's designed. So that's a conscious decision made by management on how to use that facility. And I'm trying to be very practical in this. If you got people running around trying to figure out what surplus capacity is, I think that's going to be a waste of a lot of effort. So that was why I made the comment I did. Ian.
Thanks, Scott. And I think at this point, probably the thing to do is actually just ask Jonathan or Steve if they'd like to just give us an idea of how the valuers might think about this, and then I'll open up for member comments. So I don't know, Jonathan, do you want to have a go at this one?
Yeah, I think in terms of surplus capacity, it may come down to being a case of recategorizing that the surplus capacity is surplus space. So if we have 2 extra floors in an office building that's capable of separation and is surplus to capacity, it could be carved out and valued at fair value under surplus category. That would just be an initial thought on how a valuer may look at this issue, but in tandem with discussion with the client on what their intentions is for that space going forward.
Thanks, Jonathan. And I think that it is actually consistent with the kind of debates that we had on our standard on assets available for sale and discontinued operations, because the key principle there was that you could actually access that market, that fair value. And so I think what you said there is there would be a distinction between a couple of floors that you could actually let off separately versus, for whatever reason, that was just redundant space that you couldn't actually access that market value. David, from the task force point of view, and then I'm going to go to the comments from Adrian and Todd.
Thank you, Ian. I think I wanted to pick up on a point that Jonathan made, which some of you might not have picked up on, and that is it's the communication between the client and the valuer. It is the management, picking up on Scott's point, it's the management of an organisation or an entity that decides what space is, well, what capacity is surplus. So if you pick up on Jonathan's example, yes, if the management has got 2 floors of the building that it can carve out, rent out separately, then that's one approach. If you're in certain public sector entities, you might have got 2 floors that are spare, but if you're an embassy, for example, you probably wouldn't want anybody else in that building. So that space is redundant space, but you wouldn't classify it as surplus capacity available for renting out. So you'd have to inform the value of your precise circumstances, and that is a key communications issue between the if you like, between the accountants and the valuers. And I don't think it actually happens a lot at the moment, and that causes a lot of the confusion.
Thanks, David. I think that underlines the communication point between the professions and so on. Evie, Adrienne, you've been waiting, and then I'll go to Todd.
Well, going on Scott, Jonathan, and David's, I would say and understand that circumstances are key in this matter. But then I would like to take 3 examples. The first one is Scott's. Of course, if they have 2 stores in excess, the company will make the same profit, generate the same profit with only 1 store instead of 3. So this is actually, could be actually a surplus capacity. If you go to the embassy, the issue will be with the existing location. Now, of course, you could decide that 2 additional stores would be in excess and surplus capacity, but you have to deliver the service, the diplomatic service at the location where you have located the building. Now, going to the school is different. You have a school that is designed to host 1,000 pupils, but we can only because of the local social, factors, we can only welcome 500. But you have a 500 surplus capacity. Now, the 500 capacity that you do not make use of can provide an additional service, which is not the case with the company, with Scott's company. So there is a difference between the 3 examples. And now my question would be, how do you account for the 500 capacity of the said school?
Thanks, Adrienne. So I think I will ask that question to Jonathan and Steve in a moment. I just want to pick up Todd's comments at this point in time, and then we'll just get some input on the point you've raised, because I think that is an important third case. Todd.
Thanks, Ian. And I think really the point that I want to make has probably already been made. I was nodding vigorously as Jonathan was speaking. So I think there is something that needs to be articulated as we work through this in our literature around surplus capacity. And maybe I can use one of the examples from Adrienne. So the school that has been designed and built for 1,000 students, when it comes to valuing that for its existing use, if, as you forecast out into the future, you will never have more than 500 students in that school, then its existing use, you're wanting to value that asset for 500 students in my mind. And if the asset can accommodate 1,000, then you've got some surplus capacity that you need to think about. And I think we will need to work through what we would expect to be done in terms of valuing that. So if you can separate that off and lease it out or sell it or whatever, fine, fair value it as part of the valuation that you're doing. And maybe you can't do that. And so we need to work through, well, does that mean that you put a 0 value on that, or what do you do? But definitely surplus capacity has to be dealt with as part of what we are doing here.
Thanks, Todd. So before coming to the school question, perhaps one thing that occurs to me that we could ask the staff and the task force just to work through is we did discuss the list of criteria that are now in IPSASB 44 in terms of ability to access fair value. And perhaps we can ask you to have a look at that in terms of, could we use those criteria here in terms of essentially Scott's first example, which you have 2 floors that you can actually rent out. Do the list of criteria help us? Now, I'd just like to move on to the example that you and Adrienne have just been talking about, which is the school example, which I think is very pertinent, and just get a sort of valuation perspective on that, if we can, for a moment. So again, Jonathan, Steve, over to you, whichever one wants to pick it up.
Yeah, thanks, Chair. My own personal view is that, you know, if the capacity is never going to be more than 500 pupils, that additional space really is surplus, or in any event doesn't really have much value. If it can't be carved out, and you know, it's not adding anything to the operation, I don't see that it has significant value. Just as an initial reaction.
But then I think that the point then goes back to, okay, you know, it is, let's say, designed full capacity would be 1,000 students. It's now being used by 500. So I think, you know, kind of in an accountancy mind, I would say, well, okay, so I'm not going to be able to, you know, because I know the population has gone down. Therefore, you know, as long as I've got to have a school in that area, I'm only, you know, that 500 is the kind of expected. So therefore, there is actually what I might think of as an accountant as an impairment to the full value. I don't know how we describe that. So I think consistent with what's been Todd's comments, I think we need clarity about how you would address that issue. And that's probably not for discussion now. I think that's something where perhaps as a, you know, the board needs further clarification on how that would be approached, would be my suggestion, because I think we could debate backwards and forwards at this point in time. But again, I think it comes back to what's the nexus between what might be in the valuation guidance and how that might fit, for example, with our impairment guidance in IPSAS 21, in terms of the indicators there and how you might approach that. So I think that might be the way forward. David, you're sort of hovering, I think.
Yes, thank you. I mean, Dave and I've just had a quick chat, and I think perhaps picking up on those three examples and working with the task force, which of course includes Jonathan, would take surplus capacity away. And although we have already got guidance in the draft ED or in ED 77, we'll work up some more and bring it back to the board. I think that would be the easiest way for us to do it, rather than keep talking around the table.
Yeah, and I think, but I think the specific instruction is, can you have a look at that in relation to what we've got in IPSAS 44, and also what we've got, which is, can you access the market? There's the fair value, and then the second one is if you can't access the fair value, then to what extent does this interface with our existing impairment guidance? And you know, I think open question there, but obviously that's the nexus then between our existing literature and what's in the you know, what approaches would be taken from a valuation perspective. So thanks for that. So Lindy and then Scott.
I suppose just adding to the way forward, but I think also looking at the existing use and existing asset, I think that also helps you to define the unit of account, because then you would look at what the capacity of the asset that you are using, and the remainder would be something else that you would consider. And that's why also looking at the rights of the assets and then identifying the unit of account on which rights we are valuing, and then the rest would be considered elsewhere. Thanks.
Okay, thanks, Lindy. So Scott, to you.
Yeah, thank you, Ian. I want to clarify something I said, but I want to add one more example to the table that you may want to have the task force look at. And that is, I think surplus can just be handled in the definition that's there. I don't think you need to do something separate. I think it can be handled in there. But everybody's assuming the surplus is about impairment. But let's take the school example again. It takes so long to build a school. I have to project what the enrollment is. I'm a growing population, so I may intentionally open the school with 2 to 3 extra capacity, understanding in the next couple of years I'm going to grow into it. Okay, so surplus capacity is not always about impairment. Actually, they may have planned it that way, and that is and if you don't include it in evaluation, then you're basically not charging the cost of that into the financials. So that's my concern. Thank you.
Thank you. Now, Ajith, there's a quick point because we've got 10 minutes and I want to get on to discuss location before.
Yeah,
in addition,
just a quick point. I think I was thinking of the situation of a school with excess capacity. I think if you look at from a technical perspective, one that would be easiest and most practical would be probably to do a depreciated replacement cost and of the school, and then if there's an impairment, then recognize that impairment, identify that impairment separately because of the excess capacity, if it is permanent excess capacity. I think that might be a proper practical approach that we can use in the case of the school. Thank you.
Okay, thanks. Lynn, is it a quick point? Because I do want a discussion on location before we finish. And I don't want any further discussion on techniques or whatever. I think the instruction for the task force is clear.
Can we also instruct the task force to think about, we've talked about surplus capacity, but what about the opposite situation where you've got an overcrowded asset and your intention in the future would be a need for a bigger asset? I think we need the answer that works both ways from a conceptual point of view. Whilst I might have a view on it, I could express it. I think we do need to we need to think about, if you end up with an answer on surplus capacity, that does it have an impact if you've got the opposite, and what should that be?
I think though we do need to guard against the trying to, anticipate the future rather than the existing. I mean,
So
I take your point,
which could be my answer on surplus capacity, quite frankly. So, but if you suddenly end up with an answer, you think it's okay to anticipate the future on surplus capacity, how would that work in the opposite scenario?
Okay, so I want to finish off and just have a discussion about the existing location point. We will come back probably on Friday to the discussion about the income approach, but I just want to have this discussion on existing location at the moment. So I think we have a proposal in the paper. Sorry.
We already presented.
Yeah, okay. So essentially the analysis it goes across between page 4 and page 5 of item 4.2.4. So can I just pick up comments on the recommendation there from staff? Lynn.
So when I read this, I felt it read very rules-based and not, didn't pick up the nuances that we've picked up in some of the other discussion. So that was my hesitancy on this one, because I think you might end up with yes, but only in a defined set of circumstances. And I didn't think you would always, this seemed to be very clear cut to me in a way that I didn't necessarily think was appropriate.
Thanks, Lynn. Todd, if I can go to you.
Thanks, Ian. I didn't quite have the same reaction to this as Lynn. I think, it is right that we talk about in the existing location. So we're not thinking of a bit of land 10 miles down the road if we're valuing this building. So it is in this location. And that probably goes to a point that Ajith raised earlier about how you might value land, because I think he does have a point in terms of land's land. It doesn't really matter what use is being made of it right now. And so I think there is something that we need to think through there in terms of the land valuation side of it, which is probably, my main reaction in terms of this was taking it back to the existing use value as that had been explained today, which I do disagree with.
Okay, thanks. So I'm just going to collect comments rather than debate it further, and I think what we will then the action will be for the staff and the task force to take this away and come back to address the comments that members make. So if I can go to Lucy and then to Patricia.
Yes, thank you, Chair. I agree actually with the staff recommendation to retain the core principle on core COB principles. However, I want to share with you concerns raised by some constituents from the Philippines on the operability and practicability of in the application of existing location principle. For instance, in scenarios where a non-financial asset, like for instance, an equipment belonging to the central office of an entity, and this is temporarily relocated to one of the entity's regional offices to be used for service delivery in that regional office for, let's say, 2 years. Then after the 2-year period, the equipment will be returned to the entity's central office. Now, following the explanation in the agenda paper or the existing location principle, it means that at reporting period, the loaned equipment will have to be measured based on its value in its current location, which means the regional office. And because it is now relocated to a far-flung area, the asset might be measured less than its carrying amount. So how would we treat now the difference between the carrying amount and the value in its present location? The other concern is that would there be an option for an entity not to measure the value of the equipment where it currently is and just disclose it in the notes of financial statements that such low equipment is loaned to its regional office for 2 years? Because example in paragraph 87, in paragraph B7, appendix B of ED 77 is a building which is an immovable property, and the existing location consideration is clearly understood. So I suggest that we consider an example of a movable property, such as the equipment in my example, which can be relocated by an entity as needed to meet its service delivery objectives in order to lucidly demonstrate the consistent and the practical applicability of the core existing location principle of the in measuring the asset at reporting date or measurement. Thank you.
Thank you, Lucy. Patricia.
Thank you. I agree with the principle, but I'd like to suggest to clarify where the existing location assumption is applicable, because for some assets, I think it's not applicable, or I think it's necessary to discuss about this. For example, intangible assets, movable assets, in which, what is the situation that I use the location? And another point that I would like to present here is initially we decide that this specific measure for public sector are entry value and specific. I think we should to discuss this point too, because can be a consequence in terms, for example, in the optimize the use of market participant information. I think it's necessary to review these 2 points too. Thank you.
Thank you, Patricia. Vietran, were you in? And then I'm not going to take any more comments because we need to finish this session.
Well, I see with the existing location principle the same issue as we had with regards to the existing use, because, well, first of all, I can't concur with the last sentence of 8C that says it may be possible to deliver service from another location, but it is unlikely to be in the public interest, etc., given that was selected for service delivery needs. But the problem is that it might not be for the same service provider or the same service needs. For instance, if you locate a central government service somewhere, it might be for reasons of land or regional development or land planning, rather than the real needs of the service provider. So the sentence might not be always true. And what happens is, for instance, take the example of central department servers, IT servers. We can locate the servers anywhere. Now, if you locate those servers in a building that you acquire downtown New York, it might cost you, I mean, the building might be worth, from a market perspective, much more than if you locate it in, I don't know what, desert of Arizona, okay? But it will provide the same service. Now, why I say we have the same issue is because if the existing location increases the market value, is it a reason for recognizing an increased value for the asset at the location where it is located?
Thank you. So I think, you know, synthesizing the comments we've had there, I think broadly there is, you know, support for that sort of approach. But I think going back to Lynn's opening comment, the way in which it's being expressed at the moment is perhaps more rules-based than principle-based. And I think if we can get the principle right that is driving this, which is why do you have to have it in that location as opposed to somewhere else, I think that's what we need some further thinking on. And then if we can get that principle right, then what does that drive in terms of the approach to valuation? I think that's, you know, and again, it's some of the ideas that we've had earlier are, you know, is that then related to specialized, non-specialized, for example? And also, you know, this sort of, again, the factors that we've had, you know, about can I realize a fair value or not? I think are going to be relevant. So I think, you know, if the instruction is for the task force to take away members' comments, really test it in terms of can we get a principle-based approach to this, there would be support, but it's about, you know, getting the frame right, if I can put it that way. And I think, you know, what it means in valuation terms would then probably address some of the points that Patricia was actually making as well. So if that's okay, does that make sense? Given that we are just slightly over time, talking to the Secretariat, we do want to have a discussion about the income approach. Clearly, we haven't got time to do that justice today. There's also probably, is there any issue principle that we need to pick up in terms of how the instructions from the March 2022 meeting have been addressed? So what I'm going to suggest is that we bring that back on Friday morning, well, the Friday session, Friday morning in New York. Unfortunately, we won't have Jonathan and Steve with us then, but you know, I think we can collect comments and take questions back into the task force. So I think, you know, just to wrap up, then I would say, Jonathan and Steve, thank you very much. I think you've really added to our discussions today, and I think it's been fantastically helpful having that perspective into our discussions. You know, so thank you very much for the time. Thank you very much for all your input to the task force discussions. both past and to come. And I think certainly, you know, we will be looking at the resolution of these issues and the way forward, you know, through the next few months and in our September meeting. So certainly, I think we would extend you an invitation to attend either physically or virtually for that. So thank you very much for that. Thank you very much to members as well. I think we've had some very good discussions, and I think it's really showed the breadth of the issues that we're working with at the moment, interfaces with other projects and so on. Ross, final comment from you, and then we'll finish this morning.
My comments for once we close the meeting online, just for people in the room, just a quick reminder of the protocols for the week for those attending in person.
Okay, so thanks very much, everyone. I think that was a very good session today. We've made a lot of progress. Okay.